Good afternoon. Welcome to this industry-specific internal audit program for financial service sector entities. And as you would all be aware, this is a program which we are hosting, organizing along with our partner institute, the IIA Mumbai chapter. So I welcome you all to this program. May I first request all of you to come to attention for the ICI motto.
Yaesha supteshu jagrati Yaesha supteshu jagrati Kamam 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 Pursho nirmimanaha Tadeva shukram Tada Brahma Tadevamritamucchate Tasmin lokaha shataha Sarve tadunatyati kaschan Etadvaita
Thank you, everybody. First of all, let me welcome, of course, the delegates and the dignitaries with us. CA Huzeifa Unwala, Chairman WRC, CA Percy Unwala, President IIA Bombay Chapter, CA Ratna Daftari. Our faculty for today, CA Huzeifa Unwala. We also have our third subsequent faculty, CA Rahul Zaveri. So welcome all of you. Friends, basically, the intention of today's program is to cater to specific industries or sectors. And you will find that increasingly in the coming days, we will be increasing apart from general internal audit programs, we will be also be doing a lot of programs which are targeted at specific sectors like say pharma industry or maybe the automobile industry or service industry, etc. So this is one of that attempt. We hope that we have designed the structure to suit this particular sector, which is the financial services sector. And I hope we have some excellent faculties today, and I hope all of you have a good learning today. So again, welcome to all of you. Now I'll request CM Huzeifa Unwala, Chairman WRC, to kindly deliver his address.
Thank you, Rahul. A very warm good afternoon to all the participants, and I welcome everyone. Let me first thank Percy, President of IIA Bombay Chapter, for agreeing to jointly do programs with WIRC, the Internal Audit Committee of WIRC at ICI. And we have done programs in the past. This is again one in the series, and now a unique idea coined by Rachna at IIA Bombay Chapter and Rahul Parekh, Chairman of Internal Audit Committee, that we should do industry-specific internal audit program. So congratulations to both Rahul and Rachna for the excellent work. I think good idea, and we can have specific industry-specific topics can be covered and learnings can happen. Let me also thank CA Huzeifa Unwala. He is an expert in internal audit, but especially on the banking and financial side. He does a lot of work, and he is going to talk about the audit universe and what can be audited in a financial service entity, followed by Ajay, who covers a lot of IT aspects in the financial service industry, and then Rahul Zaveri, who will cover the operational risk in the, again, financial entities. So I think really well-designed program structure, and we will ensure that, like, whenever the team says we are ready to do a lot more. And in fact, we were just discussing right now that we should do physical now. The next program should be physical, and we will try to plan in advance so that more and more participants come that way. So let us plan towards that angle. And at ICAI, at WIRC, especially this year, we are trying to bring different technical subjects to the members' knowledge, so that they can pick up whatever area they want to practice in. Similarly, when we talk about practice, similar to what we have started here in Intern Audit, we started a GST series, which is again an industry specific. So like someone one day comes and speaks on hospitality. Then we talk about real estate construction. So like 3 hours dedicated, what are the indirect tax implication that way, because it is essential to get industry specific knowledge and the intricacy so that we can add value to the clients. That is important. And of course, lots of programs we are planning on technology as well. So we request everyone to join us in all the programs and take benefit of it. And if you got any feedback, any suggestion for us at WIRC or at II Bombay chapter, let us know. We are happy to implement that. With that, thank you very much. Happy learning to everyone, and over to you, Rahul.
Thank you, Murtuza bhai. May I now request CA Percy, the chairman of the Bombay chapter of IIA, to kindly, the president, sorry, the IIA Bombay president, to kindly give his address. Percy, you are on mute, please.
Yeah. So thank you very much, Rahul and Rachna, for really putting up this program, industry-specific internal audit programs. We will have this every 2 months, I think. And today being the first, kickoff session, it's on financial services. We have the best of the speakers and very interesting topics covering the industry. So I think it's really a great effort by both of you. Of course, supported by both the institutes. Murtuza is always very supportive when it comes to collaboration with IIA. This is the 3rd program I think we have done. I think the last one was in January, which was equally successful. And with this year's mission, when IIS Bombay chapter started off, it was collaborate to grow. So I think this is the right platform. WRC and IIA is collaborating. Likewise, even across other other IIA entities and ICAI entities like EIRC and IIA Calcutta yesterday had a joint audit conclave. So this is also happening across the country, and it is very essential that all the professional institutes cater and deliver to the field. So with this, I would just like to also familiarize our members with what are the options available from an IIA perspective. It's not a marketing pitch. I'm just trying to just create an awareness of the institute's certification which is available. The Institute of Internal Auditors US has this prime certification of certified internal auditor, and traditionally it was being offered in the 3 exam parts, and from last year, I think they have started off CIA challenge exam, which is basically taking advantage by the members of 17 institutes, which ICAI is one of them. And to have this fast track certification instead of earlier it used to take about a year and a half for any average person to get qualified. Now within 2 months or 3 months you can clear and get your CIA certification. So why should you get a CIA certification? Basically, it's globally recognized. It creates proficiency, credibility, and improves competencies between us internal auditors, higher income opportunities, job opportunities it creates, and a lot of expertise material is available, knowledge sharing material is available by the institute. So it's like, after clearing chartered accountancy, which is like an MBBS, sometimes you need to have a specialization. So if you are in the internal audit field, then obviously you would like to have the CIA certification. If you are in the forensic field, you might like to, cover the CFE certification. So it's like that. So I think it's very essential that we as members scale up our learning and, get this certification. So I covered this qualified accounting bodies, which are from the IFAC. It's a what is CIA challenge exam? It's a condensed exam covering all the three parts. In a traditional exam, in a traditional CIA certification, you had to appear for 3 times, 3 parts. But in CIA challenge, you need to appear for all the 3 parts in one exam. So you can become a CIA overnight, instead of three exams. These are the associations who are affiliated with IFAC. So you can see that association of, ninth institute is our ICAI. How do you register? So there are various links available on II India and global. Currently, this registration is ongoing. So June and September are the months when this registration window is open. You can take the exam in August and September. This is the registration fees, approximately $900. I would all encourage you to, appear for it with your full force. Not think about a retake, because retake is very expensive. So again, how does it compare with the regular 3-part? There is no comparison, frankly. It's a lot of time saving, a lot of cost saving. How do you take it up? You become a member of II, then apply for this CIA challenge exam. There is a step-by-step procedure which is available on the institute's website. FAQs are also available. You can glance through it. I can share this presentation with the participants as well. And these are the contact points in case you would like to register. It's still 5 days for June to get over, so you can still make a start. And thank you very much.
Thank you, Percy. Thank you very much for updating us all on this CIA challenge exam. So I'll now take this opportunity to introduce our today's faculty, CA Huzeifa Unwala. So Huzeifa sir is a senior partner and founder of GHS and Associates LLP. He is also a board member of Dixon Asia Pacific Private Limited as a non-executive director. And he has more than 23 years of experience in, serving various international large and mid-sized clients in internal audits, management consulting, business advisory, SOX, IFC implementation, and enterprise risk management, etc. He has played a key, leadership role in career mentoring of large audit teams and has served global clients. He's also an author and speaker at various forums, including our institute's forums. So with these words, I welcome Huzeifa sir to this today's session on, and he will be taking up the topic need for risk-based audit. So, sir, with these words, I hand over the charge of the session to you. Thank you very much for accepting our invitation and being here. Thank you.
Thank you, Rahul. Thank you so much for the warm introduction and welcome to this session. I would like to acknowledge the presence of our WRC chairman, Murtuza Kachwala, and thank him very warmly for inviting me today here. Percy, president of II Bombay chapter, Rachna, for having orchestrated this entire program and seminar. I hope my voice is audible and I'm clear. Great. Fantastic. So I'll just share my slides. There are about 25-30 slides that I've prepared for the session today, and I'll quickly take everybody through that. I hope the slides have come up on screen and visible to everybody. So the topic of the session is risk-based internal audit need and implementation. It's come at a very opportune time, I would say, where the primary regulator of the country, Reserve Bank of India, is looking to aggressively encourage, promote, and implement risk-based internal audit in the shadow banking fraternity of the country, that is the non-banking finance companies. And as far as the banking fraternity is concerned, implementation of risk-based internal audit now stands at a very high level of maturity. However, India as one of the primary powers in the world, aligned to the Basel framework and the Basel Accord, has moved towards risk-based supervision. So all the regulators in the country are now aligning towards a risk-based supervision initiative and framework, where there is a combination of on-site and off-site monitoring of supervised and regulated entities, whether they're banks, financial services companies, non-banking finance companies, insurance entities, etc. And so is the capital markets regulator, SEBI, who has come down very, very specifically on risk-based supervision and risk management framework related auditing. And all these prescriptions have come out in the last couple of years, as recent as 2021 and also a bit in 2022. So the framework of the presentation that I will present to you today comprises of 2-3 components. First is I will take you through the need for risk-based internal auditing, which is actually a no-brainer. Everybody in today's day and age appreciates and understands the need for risk-based internal audit, but we will just reinforce the needs for risk-based internal audit. Then we'll move towards the regulatory prescriptions in terms of what the regulator, primarily Reserve Bank of India, have taken as the base example here, considering the fact that a lot of NBFCs, housing finance companies, etc., have to implement risk-based internal auditing frameworks in the current financial year, which applies to them. So I'm taking the Reserve Bank of India's guidance on risk-based internal audit, which is by far the most comprehensive one available among the financial services regime in India, when you compare RBI with IRDA and few other available circulars. So I've taken the RBI as a backdrop. So the entire discussion today will be around the RBI's prescription. And towards the end, we will also go through certain challenges which arise while an organization is transitioning into risk-based internal audit methodology and framework, and what are the skill sets required to succeed in an environment of risk-based internal audit. So these are the components that I will be touching upon today. Let's look at the context of risk-based internal audit in terms of the macro picture, and how does it impact the micro picture that impacts the internal auditors as the last key in the value chain. When you look at the global context and the Global Risk Insights report of 2022, there are some alarming threats and risks that are forecasted basis historical analysis of risk factors, and all of these are touching our lives today. Actually, we are experiencing the post-COVID world today in terms of vaccine inequality and COVID variants that keep on emerging like waves month after month, primarily on account of the vaccine inequality that has hit the globe in the COVID world. Almost 50 to 60 countries that are in the low to middle income category, the vaccination rates are as low as 6 to 10%, leaving a large chunk of the population in the world out of the vaccinated family. So what it means is that, the infectious disease will keep on coming back in different variants, and probably there may not be an end to the COVID phenomena very soon. On account of this, there are a lot of global developments that are happening. There is uneven economic recovery even post the pandemic, which we thought would end somewhere in early 2022. As a result of which, the economic recovery of countries and regimes are highly unstable and uneven. So much so that the World Bank has predicted that almost 24 countries are at risk of sovereign defaults. Now, when these 20 to 24 countries are at risk of sovereign default, there is a looming debt crisis which keeps on impacting the cost of capital. And there is tremendous net interest margin pressure, especially on financial services players, as we have seen in the country today. Sudden rise in the cost of capital by RBI spooked the capital markets. It spooked a lot of balance sheets, a lot of quarterly results, etc. So all these global trends are actually percolating down to corporates and then down to the internal auditors in terms of impact on people, policy, processes, practices, culture, and conduct. Like the COVID impact left the banks wondering whether they should have a branch or they should not have a branch at all. And a quick adoption of digital strategies became the order of the day, and rapid transformation to business models started happening. So much so that there were so many cloud business models that were born in the last 2 to 3 years. And even financial services players now value those companies more. Those don't have physical presence, but rather the entire work is done out of a digital framework or out of a cloud platform. So even the basic KYC process in a financial services unit now has become digital in the form of video KYC processes. So the internal auditors' work has really impacted a lot on account of these global risk factors, volatile environments, growing digital dependencies that are altering our societies, consumer preferences, investor preferences, and there is so much bargain pricing that is happening on the internet, whether it is an insurance policy you want to take, whether you want to take a housing loan, or whether you want to buy a white goods. For everything, there is a bargain price available because there is enormous input cost pressure on the supply chains that make organizations do things to survive and to sustain and to become more agile. And in this entire phenomena, what's happening is that the entire value chain of audit is getting disrupted. And the internal auditor is left thinking that what is the approach one should take. It should be a traditional approach, it should be a risk-based approach, it should be a combination of both the approaches, it should be an approach of only relating to data testing and automated testing of internal controls. So all this is creating a lot of thoughts and a lot of complexities in the minds of audit fraternity today. But the regulators fortunately have come to our rescue, saying that there is no other better way to do internal audit than to follow a risk-based internal audit framework. So much so that the regulators have called out in their circulars that risk-based internal audit is vital assurance to the board of directors, and would cover not only the plain vanilla internal controls that we review in the internal audit process, but would cover the governance and risk management systems of the financial services players. So that's a broad brush in terms of what are the global risk factors. Due to paucity of time, I'm not able to delve into each one of them. It's already outlined clearly on the slides. I'll move on to the next slide now. So this is a snapshot that in a risk-based internal audit environment, what are the key expectations that the stakeholders have? So starting with the regulators, like say a Reserve Bank of India, IRDA, or a SEBI, only desires that auditors find out and unearth frauds, apart from the plain vanilla assurance and protection activity that internal auditors do. So we have to be very mindful of our audit planning, our programs, our risk and control matrices, checklist, audit evidences that we have. Regulators also in the regime of a risk-based supervision are doing on-site and off-site monitoring, doing structured meetings with the supervised entities almost on a quarterly basis for significantly large supervised and regulated entities. They are desiring something like certificates that the internal auditors issue. And it manifests around number of recent regulatory developments that we have witnessed, whether it is related to office account certification, whether it is related to NPA automation initiative pronounced by the regulator, and the bank has to show compliance towards that. So there are a number of certification requirements emerging from the regulators, and even the management and the board wants the internal auditors to issue a lot of certificates to give assurance to the regulators. So this is emerging as one of the key expectations which the risk-based internal auditor should keep in mind while doing the entire planning for a regulated or supervised entity, that there may be ad hoc requirements for certifications. From the CEO's side, they want one-line assurance that the value that they are creating is protected and there are no challenges to that. CEOs don't like to see any disclaimers in the report. There shouldn't be any surprises. CFOs always like to see value-added stuff in the internal audit report, cost savings. Also, the desire that the internal auditor gives full assurance, but in lesser time and seeking less information and management bandwidth. The audit committee, of course, desires 100% assurance on statutory compliances, more so in financial services and regulated entities, on key processes relating to products, payments, customer acquisition channels, and digital transformation that the regulated entity is taking up. There are so many unanswered questions that come into the basket of internal auditors. Statutory auditor, the framework and the scope is very, very clear. For various other types of audits, the scope is quite clear. But the internal auditor scope in a financial services entity is quite comprehensive. It's very, very complex, and it covers an audit universe that is distinct and large as compared to any other unit. So sometimes the auditable units in financial services industry range from 30, 40 auditable units to 200, 250 auditable units, because the auditable units or the universe would comprise of products, functions, they would comprise of geographies, they would comprise of technology, transformation initiatives, regulatory compliances, treasury management, investment management, the portfolio of loans. Again, within the loan portfolio, there would be so much of variety. There could be housing loans, gold loans, retail, corporate, wholesale. Now you have the entire ambit of asset reconstruction, the security receipts, and so forth. So the audit universe is going to be increasingly expanding and complex as far as financial services players are concerned in the risk-based internal audit scenario. Auditees, of course, don't like any adverse ratings and reporting of misouts. Now, in this context, moving towards the risk-based internal audit regime, I would say is a no-brainer. The internal audit team has no option or choice but to adopt and adapt to risk-based auditing frameworks, which are prescribed by the Institute of Chartered Accountants of India as well as IIA, very comprehensive frameworks that find mention in standards of internal audit issued by the Internal Auditing Standards Board of ICI, as well as the IIA Professional Practices Framework prescribes risk-based internal auditing methodology and the waterfall very, very clearly. If the internal auditors don't exercise the option of risk-based internal audit, they would be open to so many risks and adverse remarks from the regulators, from the board, from the audit committee, because it is humanly not possible now for the internal auditor to conduct audit in a traditional manner and cover the entire universe of risks that a supervised entity is exposed to. So the best tool available to the internal auditor at his disposal is to do a smart and sharp risk assessment. This also allows the internal auditor to balance the cost-benefit equation in his favor, because the moment a sharp risk assessment is done, then the prioritization of resources can be done on the basis of risk assessment, and there is a possibility of minimizing the number of resources that are deployed on the audit of a financial services player or a supervised entity vis-a-vis the traditional audit, where a certain percentage of samples would necessarily have to be ticked in the box to demonstrate the effectiveness of the internal audit approach. Now let us look at the key elements of the risk-based internal audit methodology as prescribed by the Reserve Bank of India's circular applicable to NBFCs, to housing finance companies. Now this circular is very similar to the circular that applies to the banks also, which is the old one, and the risk-based internal audit guidance note issued by the Reserve Bank of India. We'll go through the overall guidance and then move to the steps of actually implementing risk-based internal auditing quickly. So first, the circular leaves open the interpretation to the imagination of the internal auditor in terms of risk-based internal audit framework by stating that risk-based internal audit is an audit methodology. So Reserve Bank of India is not prescribing very, very clearly the definition of risk-based internal auditing. However, giving the principles in the circular of what a risk-based internal audit should comprise of and should have, but it has stopped short of defining what risk-based internal auditing is. So in this context, then we fall back on the standards issued by the Institute of Chartered Accountants of India, as well as the definition of IIA, so that the internal auditor can have a scope and boundary in terms of the definition of the risk-based internal audit framework. What the circular also mentions is that risk-based internal audit is a methodology that links an organization's overall risk management framework and provides an assurance to the board of directors and the senior management on the quality and effectiveness of the organization's internal controls, risk management and governance related systems and processes. So in a nutshell, it covers governance, risk management, internal controls, systems and processes of the regulated entity. So this is the broad definition of what the regulator has to say on RBIA. It further says that internal auditors should use risk-based approaches to determine their respective work plans and actions. It should do the internal audit department should do a robust risk assessment. Robust risk assessment, it also states, should include the views from senior management and the board of directors. So what this means is that there should be a collaborative approach to the subject of risk-based internal audit. It cannot be a solo effort from the Department of Internal Audit. It has to take into consideration risk, insights and inputs from higher authorities and from verticals that are parallel to the internal audit function. It could be risk management, it could be compliance function, it could be the business owners of a particular legal entity or legal unit within the financial services players value chain. So for example, it could be the digital banking head, it could be the retail liability head, or it could be the head of deposits, or it could be the head of asset reconstruction. So it could be anybody within the organization who owns a particular process, function or product and has got a bearing on the financial statements and the reputation of the organization could become a stakeholder in the risk-based internal audit implementation initiative. It is best recommended to create a committee and take a committee approach or take a core team approach towards implementation of risk-based internal audit in the organization. It also talks about creating a suitable and sufficient budget with enough flexibility, because there are so much business events and external events that are taking shape almost on a monthly, quarterly basis, that the internal audit team will have to have flexibility of dropping certain items, taking up certain other items in the risk-based internal audit plan. So the budget should have an element of flexibility in terms of cost and resources. It also talks very clearly about the fact that the internal audit department should execute the internal audit within the organization and should not outsource. However, where there is a need to temporarily take manpower from external sources, it could be subject matter experts, or it could be a temporary staffing situation with the approval of the senior management of the company. Now, this is a waterfall on the various roles and responsibilities cast by the regulator as far as risk-based internal audit is concerned on board, audit committee, senior management, and the IA function itself. Let's start with the IA function. The IA function has to recommend to improve governance processes on business decision-making, risk management, and control. So here clearly the focus is on business decision-making. Internal audit function should have the ability, proficiency, and capability to comment on the decision-making processes of the organization, and if there are any critical risks that would arise on account of that. promote appropriate ethics, values within the organization, ensure effective performance management and staff accountability. As far as the board and the audit committee and senior management roles are concerned, there is one standout feature in the regulatory prescription where the regulator, to the benefit of the internal audit department and the internal audit fraternity, expects that the management should give timely action plans and should present the position to the audit committee in a timely manner. So where the management teams are failing in delivering management action plans in a timely manner, the internal auditor is well within his right to escalate to the highest level and showcase that, because this is again an industry-wide problem or a challenge, especially in those entities that are not so well governed or regulated, where there is a tendency to delay the management action plans, and perhaps an open risk situation or a continuing control deficiency may go out of hand. So in those kind of situations, there is a specific feature here in the RBI framework recommended by the regulator. Then there are a lot of basic elements recommended by the regulator, and all these elements perhaps will be covered in the subsequent slides. So let's jump into the implementation part of risk-based internal auditing. This is the heart of the entire presentation of mine in terms of how an organization could look at implementing a risk-based internal audit initiative within the organization. Again, first, let's see the light of the regulatory prescriptions, that what are the desired competencies. So the first part is that any team that desires to move towards risk-based internal audit mechanism has to do a gap analysis on the current skill sets vis-a-vis what are the required skill sets. So the regulators desire that the required skill set should include core operations of the financial service players. So it is banking, it could include treasury related, it could include lending, borrowing, credit, recovery. It could include so many other aspects of the financial services players. Operations and technology is very, very critical here because everything is on the backbone of digital frameworks now. The internal audit team should have very good accounting related competencies, information technology, cybersecurity, skill set, data analytics, and ability to do forensic investigations, amongst other. The head of internal audit should be senior, independent, should have full access to systems, books of accounts, ability to form opinions on other functions, and should be given a reasonably long tenure, say a tenure of at least 3 to 5 years. So these are the elements on which the traditional team should do first a gap analysis on the competencies so that they can move into the regime of risk-based internal audit, and then look at the entire implementation framework. So let's take at the key aspects of the implementation. First and foremost is, in light of the regulatory prescriptions, it is highly advisable that a gap analysis should be done on what are the requirements of, say, Reserve Bank of India, IRD or SEBI, whichever is the backdrop framework that the regulated entity is looking at. So what are the requirements of those circulars specifically? What is the transitioning strategy, the time period, especially for doing the transition, and should be reduced in the form of a board note and a presentation to the audit committee, including the impact on the organization on account of the transition, and basis on the approval of the transition strategy, period, note, and the specific action plans. The overall framework should be designed keeping in mind. And as I alluded earlier, that it is recommended, even the circular says that since it's a cross-functional initiative, a risk-based internal audit exercise cannot be only implemented by the audit function alone. It requires stakeholder engagement. It requires inputs from the risk team, from the compliance team, from various other stakeholders. So it is important that a committee should be constituted, or a core team or a core forum should be created to live out the entire transition and go live on the implementation period. Generally, the implementation period will vary from 3, 6 months to 12 months and beyond. I know for a fact that there are quite a lot of large entities who have moved towards risk-based internal audit implementation much ahead in time, but have so far not been able to complete it. So it's only advisable that the earlier one starts implementing this, the faster they would end up going live on this entire initiative, because it involves transition of people, it involves acquisition of new skill sets, it involves partnering with new service providers, it will involve coaching and mentoring the entire organization on the concepts of risk-based internal auditing, risk assessments, on-site, off-site surveillance, and many other dimensions that are attached to this entire implementation framework. Also creating a comprehensive risk-based internal audit policy and a charter document, again very well documented in the standards of internal audit as well as the standards prescribed by IIA. One can draw down from those standards and create the purpose, the goal, authority, responsibility, frequency, timelines, performance appraisal related aspects into the policy, and dovetail the entire risk audit methodology into the policy in a succinct manner, and obtain the approval of the audit committee, which becomes the starting point for implementing risk-based internal audit initiative in any organization. Here, there should be a specific demarcation as far as financial services players are concerned between the roles and responsibilities of the risk management function, internal audit function, and the compliance function. Typically, the internal audit function is the last line of defense, but all other functions may be the second lines of defense. So there should be a very clear demarcations in the roles and responsibilities, including the handshakes and the linkages. For example, the inherent risk assessment that a financial services player has to do largely may be driven by the management team, because they are closer to the business model, they are closer to the business process, they are closer to the customer, and they know the business realities far better than the internal audit teams. And the internal audit teams could focus on doing the scoring of the control risk, and then mapping the inherent risk and the control risk put together to give a consolidated dashboard to the audit committee and to the board of directors. So there are a lot of elements which may take a lot of time and internal handshakes to be achieved. So the risk-based internal audit policy has to be comprehensive one, encompassing all these things. Accompanied by the policy, the internal audit charter can be signed off, and the overall structure of the internal audit department, because the head of department and the audit members of the function now have to demonstrate independence and compliance and adherence to global best practices. So we cannot have a situation where there are team members in the internal audit team that are conflicted for any reason and they continue to be part of the team. So that also will have to be evaluated carefully to demonstrate independence. Second is operationalizing and reporting on risk-based internal audit function. So as I was mentioning earlier, that the audit universe of financial services players is pretty complex and pretty wide. So the auditable units can vary from 20-25 units to say 200 or 300 units, and within them the risk assessment of each unit and also control testing of that, and then tabulating the results to the management. One big challenge here to financial services players is the geographical spread of the branches across the country. So typically, even a mid-size or a small financial services player may end up having 50 to 100 branches located across the country. Now, whether they take the entire branch universe as one geographical unit, they distribute it between north, west, south zones, or how they would like to deal with the risk-based internal audit at various branches is a matter of deliberation, finalization, creating consensus, and taking the approval of the audit committee. So operationalizing the audit universe is going to be complex and challenging. As a base factor, the internal audit teams could do a materiality assessment of significance on the basis of the trial balance, on quantitative and qualitative factors, on the basis of historical coverage, on the basis of past audit history, fraud history of the organization. So there are a number of factors which can be considered, and also feedback can be taken from the risk team on the inherent risk scores, etc., and arrive at the audit universe of the organization, and then move towards creating the budgeting of resources. Now, here the regulator is quite clear. They say that while the audit universe is designed and drafted and crafted, ideally it should be done on the basis of an independent risk assessment exercise. So we will go towards a template which can be used by financial services players, where they can do an independent risk assessment on an auditable universe to arrive at some kind of a score and a risk trend basis which they can give a priority and then decide on the audit frequency and so forth. Carry out risk-based internal of the risk management process within the organization. So all this can be percolated down from the universe to budget, finally to the audit SOP. And the audit SOP can also comprise of key performance indicators, turnaround times, efficiency norms, and also give some kind of a productivity output. So all this, once it dovetails into an audit SOP, will give a good framework of risk-based internal audit implementation to the audit committee, to the regulators, because also there is a requirement of, yeah. Sorry, am I audible?
Yes, Huzeifa, you're audible.
Okay.
Go ahead.
Thanks. So this also the entire framework from the strategy to the SOP would give the internal audit function a clear roadmap in terms of implementation as well as ongoing review and improvement, because the regulators also require a quality assurance and improvement plan on the audit function to be implemented. So it is not only about demonstrating good audit observations in the audit committee, but it is also demonstrating your capability and readiness to external auditors, peer reviewers, and quality assurance teams that you have followed and adhered to the risk-based implementation framework, policy, and the guidance provided by the regulators. So your work and your output is definitely going to be benchmarked in future. So we should be ready for that. We should be prepared for that. That's why the quality and level of documentation is so important while we are transitioning to a risk-based internal audit framework. So in terms of the overall risk assessment and risk identification and assessment techniques, tools available at the disposal of the management. We'll go through a few examples in the next slide as well. But generally, there could be a top-down approach that could be adopted by the internal audit function. In the top-down approach, there could be a coherence with the risk teams and the compliance teams of the organization, where the inherent risks that they have already documented and already scored can be used for the annual risk assessment exercise by the internal audit team. They can also review the output. They can add to the inherent risk assessment score if there is time, if there is enough scope for improvement. Do the entire risk assessment on qualitative as well as quantitative parameters. When I say quantitative parameters, it would mean financial parameters, that could get into threshold limits on the capital net worth of the organization, the balance sheet, the income statement, the capital adequacy, and so forth. As far as qualitative is concerned, it could be those non-negotiable parameters which are very, very critical to the organizational philosophy. Like say in case of a few organizations, they have a very, very clearly articulated philosophy against anti-bribery and corruption. So that becomes a qualitative aspect for the risk-based internal audit team to look at. The entire risk-based internal audit approach can be summed up into three components: RCI, RCU, and AAA. RCI is risk and control inventory that the internal audit team has to maintain and has to refresh. Second is review, challenge, and update. The inventory created by the management team for self-assessment, for inherent assessment, needs to be reviewed independently by the internal audit team and challenged on a regular basis for comprehensiveness, for adequacy, taking into consideration various scenarios that are emerging, the risk scenarios that are emerging on a quarterly basis, and updating the entire risk and control inventory. And last is, doing a continuous auditing on a risk-based platform, also alerting the management in a timely manner, and then creating a framework where the management can act on the open risk situation as well as the continuing control deficiencies. Now, in terms of risk identification, what are the broad units? So first comes at the entity level, at the corporate level, governance policies, risk management systems, frameworks, etc. Second is functions and products. Third is at the process level, technology level, digital adoption level, people, and geographical level. So these are the units that can be considered for the purpose of risk assessment. Risk assessment can be done through a survey approach. It can be done through brainstorming. It can be done through developing risk and control metrics. It can be done through tracking of risk events, risk whiteboards, dashboards, documenting their impacts, materiality assessment exercises, risk-focused debates, discussions, research sharing among peer groups. There are a lot of risk management disclosures that are happening in the balance sheets, on the websites of complete companies, in peer groups, etc. Those can be considered, and the risk inventory can be enhanced by using this comparison technique. A product-specific risk analysis or research, there is so much of digitalization happening as far as financial services industry is concerned. KYC is now digital in terms of video KYC that is happening. Payment channels are now completely digital, and remittances are moving towards blockchain. So product-specific risk assessment is very, very important in financial services players. Data aggregation and warehousing is happening in terms of two-way recognition of non-performing assets in the source production system, as well as the aggregate system, the NPA system. The regulator wants to see non-performing assets related identification, recognition, MIS generation from the source production system, validated with the bank's warehousing system and the aggregate NPA reporting system, which is used for the balance sheet reporting purposes. So there is so much happening in the financial services space and industry. So the risk assessment has to be tailor-made and has to be customized to the emerging business initiatives as well as the regulatory prescriptions. And of course, the traditional technique of self-assessments and measurements are equally very important to be overlaid to make the risk assessment very, very comprehensive exercise. This is a template for independent risk assessment. Now, the regulator has prescribed 7-8 key areas while the risk assessment needs to be done. The history of internal audit needs to be seen. Changes in the business lines or business focus changes has to be evaluated. Significant change in management and key personnel on account of attrition, which is one of the key risk factors, which we also discussed in the first slide, that because of the changing business environment and the mental stress that is happening in today's business situation, the rates of attrition have increased. And especially in our country, there is a lot of migration that is happening outside our country as well. So the rates of attrition, the average rate of attrition in the financial services sector is anywhere between 20 to 30%, which is very, very high. So almost 1/3 of the organization changes every year. So on account of this, the regulator wants to see the impact of attrition in the risk assessment exercise. A significant change in any regulatory reporting, any penalties, any compliance breaches reported in the regulatory examination reports needs to be covered in the risk assessment. What is the industry trend? Time elapsed since last audit, volume of business and complexity of activities, substantial performance variations from the budget, business strategy of the entity vis-a-vis risk appetite and the adequacy of the control. So this is something prescribed by the regulator as one of the key areas in the risk assessment exercise, which the internal auditor has to keep in mind. By doing so, this is the template on the right-hand side, name of the entity, location, name of the unit, materiality judgment of the internal auditor, risk assessment objective, level of risk, whether it is high, medium, low, catastrophic, critical, major risk components and concerns, history of exceptions, audit frauds, third-party outsourcing, data analytic insights, etc. These are some parameters which the internal auditor could consider while finalizing the annual risk assessment score of an auditable unit, and then arrive at the subjective levels of positive factors, negative factors, movement of the risk as compared to the previous risk assessment exercise, and what is the risk priority that the internal auditor needs to put in to determine the resources and frequency of audit. So this is a suggested template. It is not given in the RBI circular, but this is coming out of past experience. On account of the dynamic nature of the risks and the number of risk assessments that the internal audit team has to do, typically the master internal audit plan that is created at the beginning of the year does not hold good in today's business environment and the risk landscape that we are dealing with. So the internal audit team should be prepared and ready to do a multiple planning exercise as far as the audit initiatives are concerned. It's quite possible that the audit teams may undergo a change almost on a quarterly or half-yearly basis if there is a new circular from the regulator, or if there is a fraud event that has taken place, or a material breach in internal controls, and that may disrupt the internal auditor's schedule and priorities. So it is typically seen now that in financial services industry, there is a lot of dynamism in the planning universe and the way audit engagements are executed. While there is a base level audit plan that is fixed for the year, there are also a lot of random and ad hoc reviews that are scheduled and that are configured in the audit planning exercise. So again, we fall back to the flexibility of the budget and the plan and the number of resources. So here it is important that the audit team, which is very small in size in the financial services unit, could consider active participation and involvement of good service providers who can come in and who can fill the gap. Outsourcing is not permitted, so temporary manpower arrangements can be created to fill the gap and make the planning and execution more dynamic in the entire risk-based internal audit implementation. So this is the waterfall of the 3-year universe post risk assessment, how a financial services player can look at the various distributing the various audit cycles, giving a risk in the severity level, the frequency of each audit cycle, and broken down into year 1, year 2, year 3. While we are creating the audit plan for the year, we should be careful in identifying those areas that have been left out. The audit committee may be briefed on those areas which are open risk areas that are not addressed by the internal auditor's plan. So there could be a business event, there could be a risk event impacting the internal auditor's work. And it should be very clear to the audit committee that this didn't form part of the scope of the internal audit. In a financial services value chain, as I mentioned to you, the number of auditable units are very, very large, and there are a lot of process interlinkages. So it should be very clearly articulate what falls within the work of the risk-based internal audit department and team and what doesn't. And if any event were to happen outside that, then the internal audit team could definitely go back to the audit committee and say that it was not part of the internal audit universe and the scope of work. Flexibility and contingency should be kept in mind because risk is a dynamic subject. It keeps on evolving. So almost on a quarterly or half-yearly basis, the audit plan may undergo a change. There should be an annual skill gap assessment done. So for example, cybersecurity is a highly specialized area, and many internal audit teams don't have those skill sets. So perhaps they could be look for subject matter experts outside. While designing the risk-based internal audit universal plan, do keep in mind the sampling, minimum sampling requirements, and create the plan along with the sampling plan and have it approved with the audit committee. This is how a risk audit metrics, which is one of the key elements and mandatory requirements of the circular as well, So a 6-box risk audit matrix from low to high to critical to medium can be designed, and an effectiveness score can be given on the basis of the risk assessment checklist and testing of internal controls. The auditor has a choice to give a risk rated report or to give an audit opinion report or to combine the two and give both types of assurance to the management. What is clearly to be articulated is the impact of the issue, probability of occurrence, and the control effectiveness. Now we move towards contemporary RBIA function. What are the building blocks? And these are some last few slides as we are nearing 4, 5 already, and I just have 5-10 minutes left. So I have highlighted 7 components here, which would form part of the contemporary risk-based internal auditing framework if any financial services player has to look at implementing. First is the organization structure and independence. Second is strategy and planning. Third is people, knowledge and skills. Fourth is internal audit processes, methodology and resources. Fifth is other assurance service providers. Sixth is reporting and communication. And seventh is system and information. So these 7 blocks put together would create the risk-based internal audit framework that a financial services player would want to implement in their organization. Organization structure has to be independent. That is the foremost requirement. It has to be comprehensive. Skill gap assessment has to be done as part of the transitional strategy. The overall planning we have already dealt with has to be properly documented and approved by the audit committee. Internal audit process, methodology and resources. Again, the regulator says that the internal audit team should move towards implementing technology, tools and data analysis. So entire internal audit approach should be designed in such a way that we are able to cater to the prescriptions of the regulator as well as the evolving expectations of the management. So the audit workflow should be automated, ideally using audit tools. For data analytics, there should be automated testing. There should be computer-assisted automated techniques, CATs that can be used by the audit function. That needs to be demonstrated in the work completed. Where we are taking any assistance from external service providers, any firms or specialists, they should be subject matter experts. The nature of assistance should be temporary, and we should have a gap in our skills or in our headcount. We generally cannot outsource as per the requirements of the circular. The 6th requirement is reporting and communication. So the internal audit format has to be very clear in terms of risk communication to the audit committee in each and every report format. It should clearly give out the risk view of the internal auditor. Communication should be timely. The frequency of communication can be in the form of dashboard, reports, ad hoc review reports, alerts, etc. Whatever. We have a variety of options, but clearly in each of the options that we exercise, the view of the auditor should come out very clear and it should be backed with a risk assessment. The last component is systems and information. So the entire universe of auditing and the auditable entities that the internal auditor is going to be reviewing, auditing, and what are the system dependencies, what are the IT dependent controls, automated, non-automated controls in terms of documentation, access, direct access to systems, etc. Everything the auditor should be very clear. So this is a broad component-based framework for risk-based internal auditing. And this is from a communications perspective. I've already covered it quickly while discuss the component framework. These are some implementation challenges. So the first challenging is prioritizing the transition, because risk-based internal audit implementation in financial services players is very, very complex, and it requires a lot of stakeholder engagement, sign-off, etc. The sign-off between the risk team, the audit team, the compliance team, the audit team, formation of various committees, creation of budgets, the way of life once risk-based internal audit is implemented in a financial services player undergoes a change. People alignment and resourcing, because there would be skill gaps. ability of auditors to do a sharp risk assessment, imagining different risk scenarios may not exist in a traditional team. So there could be a skill gap there. Creating awareness, knowledge, and competencies, doing organizational alignment, because the risk-based internal audit policy will have to be aligned with all the other organizational policies. Budgeting resources could become a challenge because in year one, the internal audit team may not get a very big budget to transition to a risk-based internal audit activity and hire resources. So that could become a challenge and a constraint. Specialized people for risk identification as business unit level, suitable technology stack for automation, data analytics, somewhere even in case of highly evolved audit functions, moving towards robotic process automation, identifying suitable manpower, resourcing partners. So risk-based internal auditing should be considered as a journey, and the starting point should be done. There is no other option for financial services, especially for non-banking finance companies, housing companies, where the year is 20 to 23 for them to implement. But look at it as a continuous improvement journey. It is impossible to implement RBI in year one. It may take at least 3 to 4 years to do the full route of RBI implementation. And these are some future skill sets that the internal audit team could benchmark, could look at. First is the data literacy, digital literacy, being agile, analytics, and insights. So where an internal audit team can benchmark itself in terms of all these functional competencies and proficiencies from a behavioral perspective, ability to communicate well, collaborate, be curious, to do a quick and comprehensive risk assessment exercise, be enthusiastic, don't take no as an answer, be open-minded, be professional, work across teams, develop resilience, be adaptable, and relationship building, which is a core competency now for internal auditors. So with this, I complete my slideshow, my submissions and presentation. I thank you all for a very patient hearing, and thank you for inviting me today. Thank you.
Huzeifa, very, very engaging session. I think for the short time that we had, you've covered so much in these many slides, and I think you've concluded in time as well. So I think the audience would have really learned in terms of where to start. The number one question was where to start, how to prepare, when to start, because, it's already, we're running behind schedule. What is the detailed process people need to follow? What are the capabilities we need to have? Who all need to be involved? What are the, what is the practical approach to do that? I like your terms of RCI, RCU, AAA. They're very engaging. I think that kept people going. I think what's the plan? What is the implementation strategy for this? How to address the challenges? Those were the practical aspects I think I also as an audience would take along over here. Huzeifa, has been experienced in this field. I think he's been doing this not now, but for a lot of years. I think RBI has just come up to say how this is to be done. I think there was no one better than, Huzeifa to actually take us through this process, because he knows how to do this over the years. He's done this for a lot of financial services entities. So Huzeifa, thank you so much for taking us through this, and we really appreciate your time on a Saturday afternoon, yours and the audience. So to give us so much of insights in something which everyone's racking their brains with in terms of what is to be done. So thank you again for giving us this address. Yes, thank you. Yeah. Over to the next speaker. Yeah, thank you.
Thank you, Rachana. Thank you, Huzeifa ji, for a wonderful session. Now we will move on to the next session. So the topic for the next session is balancing future risk and opportunity, disruptive technology, cybersecurity, ransomware, and data privacy. And this topic will be taken up by Mr. Ajay Bhayani. Just to give an intro about Mr. Ajay. So he's a security evangelist by profession and entrepreneur by choice. Currently, he's working as director of security and partner at Ambitious Technologies. He started using computers in early 90s and was introduced to world of information security about a decade back with fascinating technology of PKI with strong fundamentals of information security. He has expert certifications in information security area like Certified Ethical Hacker, CRSC, CDPSC, ISO 2001, 2013 LA. He has been continuously working with CISOs and information security leaders to identify cybersecurity threats and guiding on how to mitigate the same and protecting their organization's brand and reputation. Yeah, so now we'll move to Mr. Ajay for his session. Yeah, what do you, Mr. Ajay? Thank you.
Thanks a lot, Vido. Thanks a lot for the invitation, and thanks a lot, IIA Bombay chapter, for allowing me to take this session. This topic is really, really close to my heart because we as a company, we have always focused on emerging technologies and what are its risks and what are upcoming things and how we can really work it. Frankly, I mean, before we start this session, I want to thank Huzeifa ji that he practically covered almost 30% and most of the hard work and weightlifting he has already done. So it will be very easy for me to really walk through the my presentation. I hope everyone is able to see my screen. Is my screen visible?
Yes, Ajay.
Yes, sir. Perfect, perfect, perfect. So the discussion for today's topic is how do we balance the future risk and opportunities in the era of disruptive technologies? What are the cyber risks? What are the issues or risks of ransomware? What are the opportunities which we have? We have been listening a lot about privacy in day-to-day life. What is uh, what is happening across the globe, and what are the opportunities for that? Also, we have it in as an internal auditors and the risk professionals, what we should be doing. So we'll be covering that. I would suggest if there is any questions, just try to put it on the chat box. I would try and cover it as much as possible, right? I'll just skip this. It's about my company, myself. Let's directly jump to the topic because we have pretty short time out here, right? So, see, I mean, when we talk about disruptive technology or a disruption, what is it happening? I mean, we have seen like from last 2 decades, after 2000 started, we have seen there's a lot of disruptive technologies coming up. A lot of things are coming up the way, and it is changing the way we are working, way we buy, way we sell, way we make the payments. Everything is changing. I mean, back in 2010 okay, sorry, 2004 or 5, we had this Reliance phones, Karlo Dunya Mitti Mein types, and before that also we had huge bulky Motorola phones, right? But today it's pretty light, touchscreen. So many activities are done from that. It's practically changed the way we work, the way we execute, the way we do businesses, way we approach our customers, right? So let's see what is actually a disruptive technology is all about. How does a disruption take place? What are the aspects of it, right? So the key aspects of discussion are that whenever this disruptive technology or disruptive concept is introduced, it radically transforms the markets, creates new markets. This is a major, major reason of disruption to happen, right? That it creates a new markets, it helps you create new business lines. It also destroys this existing markets because what happens is that it's a classical way of working, right? There are certain backlogs of that, which is, industry is not ready to leave away. And that's where a disruptive technology or a concept which comes into a mind, uh, into the industry and changes the complete way of working, right? Another important aspect of disruption is to make it successful, it should really add value to the customers, right? Either it should add value or it should bring up a new value to the customers. That's where the adoption rate of the disruptive technology comes into picture, right? Another, and again, it's not dependent on product or technology innovations. No, it is not about the concept. No one thought about, having an Uber uh, to be in place where no one is owning a company or any car and, running a fleet of taxis, right? No one even thought about, Sony did thought about having a walkie-talkie player, but no one thought about how easy it should be to offer value to the users, right? That's where iPod became the major disruptive technology or offering. There were coffee shops in the earlier parts, but no one thought about adding value, the ambience, right? The personalization which Starbucks brings in, right? We talk about bitcoins, and the challenge is that people are still saying bitcoin is still a myth, but it's still there, it is operating. No doubt markets have gone down because of that, but it is not out of the race. Bitcoins are still being predicted as the future. Of course, future will tell how much bitcoins are going to stay back or not. But when we talk about Airbnb, Amazon, it has changed the way we travel, it's changed the way we shop, right? Tell me, in last 2 years, how many have made cash payments? I have almost stopped making cash payments from last almost 1.5 years. At least in the pandemic, I have not made any cash payments. I've used UPI extensively, right? It's a disruption. UPI is today standing to challenge your visas and Mastercards, right? That's what the power of disruption is. It literally shakes the ground of the existing companies. And to happen a disruption or implementing or adopting a disruptive technology, you need not be a very large organization at the end of the day, right? A small startups can also bring up a disruptive technology, and that's where, and in fact, startups are more conducive to make a disruptive technology happen, because that in larger companies there are a lot of processes, lot of checks and balances, change management, everything else, which may not again allow them to go ahead or adopt for the disruption, right? So what is the secret sauce of, if a disruption has to happen, right? So let's look at it. It is about, when you're creating a disruptive technology or a new concept, you're working on an innovation, right? It has to be new idea, it has to change the way you work, right? And again, it's not really necessary, it can be any one of them, right? But it is so much important, or it should be so much available, that it should be adaptable. The platform should be scalable, right? The value capture is for example, how for example, UPI changed the way customers pay, right? There were payment systems, we had payment wallets in place, but with the onset of UPIs, payment wallets itself adopted UPI to make the payments, right? So that's the way the next level payment systems have come into picture. It has changed the user experience, right? Not only another important aspect of the disruption is that it not only brings the change the way the existing customer does his interactions, but it also focuses on creating the new feature or sort of a new customer base itself, right? So it's not only targeting on the older customer segment, but it also creates a new segment. In fact, if we talk about the uh, telephone adoption or mobile adoption in the country, we still have more than 60% of the Indian user base which is still not on the mobile phone. But still, we are one of the largest uh, country to adopt mobile phones in the nation, right? Disruptions can happen in the name of processes or supply chains or the way the organization functions, right? So it also changes the way organizations offer their businesses, right? Today, have you ever thought, that insurance, if you're buying an insurance, you will, you'll go online go to policybazaar.com, just put in your requirements and you will be able to buy an insurance. It has completely changed the way you buy your insurance today. You no longer depend on agents, whom you have to wait that he will come and explain you the issues, what are the benefits. It's everything there, right? Though the agents are required, but they are also adopted to the policybazaar.com, right? I'm not here again, not promoting any company out here, but this is just about taking an example what we are looking at, right? And how much available that particular product is, how easy it is to onboard that product. By onboarding that particular disruptive technology, how much it is going to affect my brand. This is what are the things which is really very important for any disruption to happen or any innovation to succeed. There are multiple platforms which drives disruption, which are commonly known. We all know them, but let's take it up one by one. Machine learning. Machine learning is something which is really, really very important, because with any disruptive technology today, uh, what I would say is that technology is involved, and to allow technology to work in a smart way, machine learning is equally important, right? How do you think Amazon is able to give you an idea that this is what you may need or this is what you should buy, right? We will definitely talk about the cyber risk and the privacy risk around that, but it is all because of machine learning. Artificial intelligence. We are talking about Teslas, the driverless cars, right? It's always because of machine learning and AI. These are two aspects of any disruption to happen. Robotic process automation. We have a lot of clerical work, mechanical work, or repetitive tasks which we keep on doing in a day for organization, which keep our resources continuously engaged. They are not doing any smart work. That's where the robotic process automation comes into picture, which automates your, let's say, for example, the moment you are doing a sales, and the moment you complete your sales call, you want an email to go to the customer that will uh, thank them about attending today's meeting, and just giving a quick 2 minutes minute of meeting discussion and all. Now that's where a robotic process automation comes into picture. The moment I complete my sales call, I click yes in my CRM that I have completed the sales call, and these are 2 points which I have discussed, and I say yes, automatically an email goes. I don't need to again go back to my email, open an email, write it down, everything, thank you, all the salutations and all. Okay, that template is already created. RPA does that. It's not only in that, it's also applicable in accounts, it's also applicable in operations. Everywhere it is applicable today. Blockchain, again, I would say uh, pretty good innovation which has changed the way we are making the payments. Bitcoin is one of the biggest example of blockchain, but cryptocurrency is not the only important aspect of blockchain. We have a lot of process automations happening because of blockchains. Government is already evaluating to have blockchains in property registrations and a lot of other use cases. So blockchain is another important aspect. Internet of Things. Now, when we're talking about disruption, earlier it used to be always about that industry 1.0, 2.0, 3.0. But when we are talking about industry 4.0 and 5.0, we are talking about Internet of Things. We are able to communicate or do the things from the remotest location just with the help of internet. Recently, the 5G was tested, and it was an Indian 5G. Kudos to India on that. But with that, the way we work, the way our industry will function will be in a very different level. We'll be able to communicate in much faster way. We'll be able to change the speed of our production in in triple or quadruple times, right? And all these technologies which were supposed to be on premise, we have all taken it to the cloud. Now we are able to operate all these platforms on the cloud, and that's the major platform which is driving disruption today, right? if you are able to do any specific implementations or any kind of disruption or any kind of technology innovations, you can do it with the help of cloud. And today there are platforms right from AWS, Azure, uh, Google Cloud Space, and there are many cloud service providers who are ready to give you that. In fact, had cloud not been there, I can rightly say today that we wouldn't have survived, our businesses wouldn't have survived the pandemic, right? It was because of the cloud infrastructure which was there. We were able to successfully run our businesses. Any queries so far before we want to, before I move ahead? Just see. Okay. While we talk about the success of disruption or a disruptive technology, disruptions also fail, right? Let's look at a couple of examples. Have you ever heard of Netscape browser? Now, this was one of the first browsers which came into existence, which changed the way we access the information on internet. Internet was pretty new. There was a load of information at that time as well already available. But the way we accessed it is having a best of the GUIs at that time. Netscape became the front runner of the browsers. But it did fail. It did understand the rising demands of the user base. It did create the new requirement, okay, or new understanding. The non-technical guys also started using internet, but it didn't understand the more usability aspect of it. And that's where Netscape failed. Google Glass, it came into existence on early 2010s, and the project was either shelled off or it was not scrapped, but it was kept into incubation because one of the major aspect of it was not pocket friendly. That was one major aspect. Another major aspect was that the expectation from the user adaptability was not that much. The kind of information it was trying to give was not enough. So yes, Google is still making their efforts to give Google Glass another chance, but of course we have to wait and watch. Till that time, as of now, it's still considered Google Glass is considered one of the most promising disruptive technology, but it failed. QR code. Now, QR code was again introduced in early 2008, right? And it was supposed to be a very disruptive technology and an implementation where it was supposed to be considered as a secure medium to exchange an information. But the reason it failed at that time was that the phones which were supposed to do a QR code scan was, let's say if I have to pass on any specific information, if I want somebody to access ambisure.com, I would send a QR code. So then what I have to do is I have to open a mobile phone, scan the QR code, and then go ahead and open and browse and everything else. Or if I have to access anything I have to do. Instead of that, people found it more easier to go ahead and Google it with the name of Ambisure. Then it's already there, and I'm able to access my information, right? So that's the reason. Another important aspect was that QR codes were used to do a lot of cyber attacks as well, or phishing attacks as well. People were, in fact, that's again happening today, though the QR codes are again widely used, but the adaptability and the awareness of that has increased a lot. And that's where QR codes are, today it's more of a success and a part of our day-to-day life. But in Korea, QR codes were used for, for the people to do the shopping when they are returning from their offices. They used to just use QR codes to order whatever they want, because there used to be like huge wall charts of QR codes for whatever you want to order. And they used to order the moment they reached home after 1.5 hours, the groceries were already there at your doorstep, right? So it was again a success, but again, it was really misutilized at that time. And that's where the QR code, lost the momentum at that time, right? So what is the future of disruption? Right? Let's look at that. Today, there are tons of startups which are available right from your bill desk to UPIs based payment systems, your banking systems, your open banking is being promoted. Your payment wallets have changed the way small banks have come into picture. The lending space has changed. The way we do the insurance has changed, right? So there are a lot of startups which are there. We have to just wait and watch today that what is really going to change, which is going to really change the way we are going to operate in the financial space, right? When we talk about the pharma space, it's already changing. There are Practo, the MedLife. We have health and wellness apps. We have got smartwatches, which are, changing the way we look at our health. We never imagined that we will be so conscious about health, how much we are going to walk, right? Which we are going to have it on our fingertips, right? We never thought of that this all the app or a technology will tell us that how much calorie we are consuming, or let's say if you have to order a medicine, right? Technology will remind us that you should have completed a medicine, you should add a new dose of you are at the verge of completing your medicine, you are at the new you have to order the new one, and you really do not have to go down to order it. Not only the health and wellness space, also in the pharmacy space or in the hospital space, there are a lot of innovations happening, and each and every sector is facing a disruption today, right? We talk about logistics and the supply chain, right? uh, there is a huge amount of disruption. We have got Dunzos, we have got delivery spaces, right? Which is delivering you your requirements in 10 minutes, where your groceries are being delivered in 10 minutes. So there are a lot of startups which are operating in this space. Now, the challenge out here is that all these startups, all these innovations, all this disruptions which is happening, they are all happening on IT systems. Their IT systems are base of your complete innovations, right? Of course, there are process changes, but ultimately everything is driven through IT. And that's where your risk on IT data, cybersecurity comes into picture, right? So let's move ahead. I've got another question out here. How do we use and apply all such technologies in small scale companies? Now, it's not that we cannot apply this technologies in the small scale companies, right? We can very well apply it. Okay, if you look at this startups and all, there are startups. Let's say if we talk about small businesses, there is something called Khata Book, if I'm not wrong, which is specifically made for small scale industry or small shops. So the startups are, when you're talking about startups and the complete landscape of innovations which are happening across the industries, right? It is looking into each and every aspect of the verticals, right? It's not only focusing on the enterprises. Okay, let's say lending craft is one of the cart is one of the lending software which gives you lending of as low as 50,000 rupees, right? So small businesses and personal level also, I never thought of having a specific application to store all my documentation, right? But it is still there. Government of India has already offered it. There are private players also already offering it, and which is allowing us to manage our personal documentation at our own space. So the innovations are happening at every place. Okay, okay. So let's move ahead. Yeah. Any questions? Okay. So when we talk about, before we get into the risk of cybersecurity, let's look at, in past 2 years, just in the pandemic, while these innovations were propping up and, we were changing the way, there were a lot of cyber attacks which had happened during the pandemic. One of the major cyber attacks which happened was of SolarWinds, right? SolarWind is one software which is used to manage the IT of of the large companies, right? Now what happened, hackers got hold of this software, and it was able to through this software, which was being operated across very large top 500 companies, right? It was able to infiltrate into other companies and hack those companies, right? It was not because of the companies were wrong. They were using the software again. The software was not wrong, but the hackers were able to get hold of the delivery mechanisms, and they were able to attack and completely disrupt the activities of a lot of companies or have an access to the data of a lot of companies. We ourselves faced in Bombay, we faced a power outage of almost almost 8 hours, which we had faced. Again, that was a cyber attack. It is fairly proven. There is a lot of documentations around it. There is recently in Ukraine, there was a cyber warfare which is continuously happening. There's a continuous cyber warfare skirmish happening between Iran and Israel, right? The Olympics and the Paralympics games, which was supposed to happen in Tokyo, it was of course postponed in 2020 because of the pandemic, but they also suffered the cyber attack. Also, something there was also Winter Olympics, which was supposed to happen, which had happened in South Korea, and they suffered a major cyber attack. So the point which I'm trying to make out here is that cyber risk is going to be there. It's here to stay, right? And there is a lot of requirements for us as an individual professionals, internal auditors to work on, on cybersecurity risk and auditing those cybersecurity risks. Yeah, right. Let me move ahead. So, what are the potential cybersecurity risks we are looking at? In case of any cyber attack, the threats and the loss of intellectual data of an organization is really big. So, for example, we talk about a manufacturing company, and if they have their, in fact, we were auditing one of the companies which was there, which was a manufacturing company, and they had recently faced a cyber attack. It was not a cyber attack. It was practically insider threat, where the one of the employees who was working with them for the last 14 years, they actually was transferring their data outside the organization. Now, this is not because of the disruption, you may say, but how it was able to do it, even though the company was following cybersecurity practices? It is because it was very easy, or certain controls were overlooked, right? When we talk about the rise of cloud, there's a single platform which was being used to share or upload or host your data, right? So that means, I'm also using the same platform, and you are also using the same platform. And if I'm using an application which will give an access to the servers, which is in the data center or on the cloud, okay, that means that my application is flawed. And because of my flawed application, the data and the vulnerabilities, hacker is able to exploit it. And with that, they are able to enter your applications or your servers, right? Now that clarity, no cloud providers do. But at the end of the day, you as an organization, you are responsible for your applications, and you have to make sure that your applications are not breached. If you're able to take care of your own application, at least you will have a better environment, right? Every day there is a lot of malwares which are being discovered. Almost there was a survey a couple of years back which said that almost every day 150,000 malwares are being created, right? So how do you really keep up with those? Ultimately, we need to be aware of those kind of malwares which are there. We need to understand, how do we protect ourselves from that? How do we do that? We need to make sure that whosoever accesses our machines, right, we give the right controls. We do not give every control to everybody. Just in the similar case which we just discussed about, had that IT guy had access to all the designs every time, had not, only because he had that access, he was able to transfer it. Had that be the right control, that the IT guy did not have a control or an access to the specific designs of the organization, okay, that breach wouldn't have happened. So the end user control again plays a major role, because it also gives that to it's a insider threat, right? Insecure APIs. Now APIs are something, today we talk about so many startups, we saw those complete landscapes. Now startups are meant to do or solve a specific problem. To do everything else, they do interact with a lot of other technology service providers, which they interact through the APIs, a software-based code, which is used to collect the information. You see companies in financial landscape, the fintech companies, right? They are payment processors, but at the end of the day, your payments are being processed at, at the banking level, right? So how it is happening? The moment you make a payment through GPay, the payment gets deducted at your in your bank account, your savings bank account, right? How does it happen? The moment GPay gets an payment notification, or the moment you initiate the payment, GPay has an API which interacts with the core banking of your bank, okay, and allows you to make the payments. The technology has made us easy to really, make the payments. But what happens? Consider that if that API is insecure, is it possible to change the amount you are withdrawing? The kind of impact which will create on your personal life because of the that insecure API. So this is again a very important cybersecurity risk, and organizations should look at. And again, I'm not talking only from the banking perspective. This is also applicable in industries, in pharma segment. Considering that, let's say for example, the APIs are utilized to order your medicines, instead of giving a medicine number 4251, it orders the medicine number 4252, which may be a completely different drug altogether. The kind of impact which will help have on your life because of that. Considering the usage of APIs in the manufacturing segment, your productions will completely go for a toss, right? Data corruption. Now, data corruption is again is used mainly. What happens is when we talk about the machine learning and the AI happens when you train machines to take specific decisions depending upon the amount of data which you have it in place. You keep on feeding that data continuously to those machines so that they can take a smarter decision, right? So, for example, I would say to the machine that this is not my earphones. Okay, this is not the case of my earphone, but this is a mobile phone. I keep on showing it again and again. What I'm doing this is a data corruption. Okay, I'm not training that machine in the right format. So tomorrow, if a machine is responding to this particular or similar looking object, it will say it is a phone rather than it is a earbuds cover, right? So that's what the difference is. What about data corruption? So machine learning and AI is also facing your cybersecurity risk. Excuse me. When we talk about web application attacks, today most of the things which we do is completely on internet. There are very few legacy desktop-based softwares which are there, right? Everything which is happening is either through web applications, right from your access of emails, your O365. You are working on your banking systems, your HRMS systems, your CRM systems, right? Everything are based on web applications, and all these web applications are either internal or external. Doesn't matter. If a user or a hacker is able to find a vulnerability on those web applications, it can again change the way or disrupt your processes itself. Data breaches, reputational risk. So anytime a cybersecurity happens, okay, and it comes public, organizations faces reputational risk. They lose trust among their customers. They lose face in front of the users, from in the front of the new customers. Your competitors use this as a marketing gimmick that okay, that particular company was compromised, it's better you work with us. Though no matter how better you are giving or a value add you are giving, but the moment a cyber attack happens, okay, you lose your data, you're going to face a reputational risk, right? Spoof chatbots. Now, when you go to any of the websites, there are chatbots who are talking to you. I mean, one of the best examples, you go on Facebook Facebook pages of large companies, right? Or on the net banking pages of, let's say, HDFCs or ICICI or Axis Bank. They've got chatbots. Okay, these are automated chatbots which basically tries to answer your repetitive questions as per their customer base. So let's say if anybody is trying to access the bank account, right, and it tries to ask you, okay, enter your 16-digit bank account number, and by doing that, Okay, you are giving an access to that particular chatbot. If it's a spoof chatbot, if it's a banking chatbot, fine, you will get directly get an access to your uh, you will get an access to your account, or you will get a direct answer that okay, this is after doing, of course, certain checks and balances, and you give an figure that okay, this is what your balance is. But if it's a spoof chatbot, how it will happen? It will try to get your bank account number. It will try to get your password. How does it happen? They try to mimic the complete banking setup, your banking web page, and you will think that it's the specific bank which is bank's chatbot is talking to you, but it may be a complete spoof chatbot, right? You will keep on getting a link saying that okay, uh, your account has been charged with so and so amount. If you feel it's wrongly charged, please click that link. The moment you click that link, you may be directed to specific chatbot to for the resolution. Now that's not the right chatbot, right? If you get any debits or if you're being charged, you will get an immediate debit from your official sources. And please do not jump on those things. It's really very important, or else you will lose up ending money, right? Default passwords is something again, today, even after having so much of cybersecurity awareness, people end up having default passwords. They get up any technology, or if they, have easy passwords. For example, 123456 password 123, Ajay 123, Ambitious 123, company name 123. It's so easy to remember those passwords because they don't want to. Because what's happening is today so many passwords you have to remember. You have got access to your personal ID, your Facebook, your Instagram, your WhatsApp, your company ID, right? On an average, every person is having more than 15 passwords to remember. Minimum 15 passwords plus your banking user ID password, your broking user ID password. So many passwords are there. It's really it's a major risk today because these are the gatekeepers of of your life, of your organization to do any work, right? So though disruption has led us to, do a lot of things in an easier way, but these are the risks which we really look at today, which is going to, if not taken care of, if not understood very clearly, or not mitigated very clearly, it's going to affect the organization and the personal working, right? So how do we really focus on, in an organization? I would really focus on the organization, and as an internal auditors also, we should focus on how do we really, face or mitigate this issue. Now, companies have multiple ways to it. But one of the major ways which today still companies are following is a reactive way. The moment a breach happens, okay, then only we will realize it, and then only we will end up having more security controls in our organization, right? That's a reactive way. It's a traditional way. It completely depends on the business. Okay, independent of business, it doesn't matter. Business does not pay much of the attention on security. Okay, ये required है, ठीक है, ले लो. एंटीवायरस चल रहा है, नहीं चल रहा है, नहीं चल रहा है. How does it really matter to me? Okay, कल एंटीवायरस की वजह से सिस्टम स्लो हो गया, तो आई कॉल अप एन आईटी के बॉस, आपकी वजह से सिस्टम स्लो हो गया है. Boss, are you really using that antivirus in the right way or not? It's as basic as that. I'm not talking about that you should not own an antivirus. You should really own an antivirus. But what is really important for your business is what you should be looking at, right? They do not have any access to the threat landscape. Okay. Uh, as an internal auditor, it is really very important for you to see that you really approach that particular threat from the risk-based approach. So I'll come to that. Of course, Huzeifa ji has already spoken about that, right? And their major focus is the perimeter defense. So when we talk about cybersecurity, what has happened is that it's a traditional mindset today, right? It's still not in the banking scenarios, but anything outside banking scenarios, I would say that it's still a traditional mindset that, okay, I have a huge firewall. I've got a VPN, which will access to the through the firewalls, which will access my servers. I've got an antivirus and I'm secure enough. No, today perimeter defense is like your four walls of your home. Do you really think that if four walls are there, your life is still secure? No, right? Because the kind of threat landscape we are also living in is really very different. We need to have a proper gatekeeper at our society doors. We need to have a proper access control mechanisms on our society. We have got cameras on our doors so that we know who is accessing or who is at our doorstep. Right? We have got multiple layers of security so that we are secure. Same goes with the cybersecurity or an IT environment. Your firewalls, your VPNs, your antiviruses are not enough, right? So for organizations with highly sensitive data, reactive strategy is absolutely not advisable at all. There is another way, which is a regulatory way, right? Now, these companies are basically focusing on what an industry regulator says. So, for example, I, as a company, I'm a banking segment, I will follow what regulator by RBI says, and that's it. I'm not responsible ke bhai, what my business is requiring it. RBI ne bola ye karna hai, karo. If you look through the RBI mandate, okay, as an internal auditor, again, this becomes a really very important aspect to look at. That if you are just following the what RBI is asking, the business will never be happy. Okay, either the people in your organization who is running that business, either they will leave or company's business will go down because you are just trying to follow what RBI is asking or a particular regulator is asking. So there is no alignment with the business. As a regulator, their work is to make sure to give a guideline or a mandate. So you're saying that this is what the bare minimum requirement in your organization is, right? They do not, and every day if you talk about today's regulators, they keep on coming up with new circulars almost every day. Now that's where the challenge comes in. Okay, आज बोला कि भाई multi-factor लगा लो, multi-factor लगा लिया. कल बोला हमको anti-spoofing technology लगाना है, anti-spoofing लगा लिया. परसों बोला कि you have to make sure that your brand. See, RBI or sorry, not RBI, but any regulator who is giving you any kind of guidelines or issuing any circular, they are going to give from the perspective of the upcoming threats or ongoing threats, which they have been visualizing it as an industry as a whole. And that's where they keep on issuing the circulars. But if you are a company, as an internal auditor, if you keep on saying that, okay, aaj ye circular ye immediately implement karna hai, no, you need to really first understand what is your business requirements, right? So there is no structured roadmap for such organizations. And that's where, they're still focused on perimeter defense. And that's why, regulator is still not advisable. They will still fail. Why? Because it may be successful for, companies which are specific to that business line. Let's say if I'm in a broking firm, I don't have any other business line, it's still fine with me. But when we are talking about, a large conglomerates which have multiple business lines, they are either in banking, they are in financial lending, they are also in broking. Now, it's very difficult that they keep on complying with 3 to 4 regulators at one shot. And with the amount of audit which comes with, it's a really hectic. Company धंधा करेगा कि regulatory compliance करेगा. So it's again next fails for those companies. Active way again, they will respond to everything. मतलब you go and tell them, you recommend, okay, buy kar lo. Okay, go ahead and buy. They will really not focus on a business part, because they do consider the business part at a certain extent, but again, the mapping with the people, process, and technology is not there, right? Because they say like, okay, we are a cyber security or cyber aware or cyber active company. Okay, this is a very good, very next generation technology. I'll go ahead and buy it. Okay, but that's again going to create a dilemma in the organization. We'll talk about a cybersecurity dilemma or a security dilemma in our upcoming slide. So the problem with this technology is that you end up spending a lot on security and making unnecessary, making your basic simple processes complex just by implementing security, right? So what is the security dilemma we are talking about? We talk about any security implementations in an organization, it depends on 3 aspects. It should be easy to use, it should be secure enough, and it should be cost effective. We are Indians, we need a cost effective, a value for money product in our organization, right? Now, when we talk about this, the challenge for security implementation is that if you are looking for a very secure product or a product which will, be more secure, which is unbreachable and all, you are increasing the cost, and the ease of use in the organization will be very, very complex. Let's say if you're looking for a security product which is very easy to use, then it may not be that secure. And if it's easy to use, that means it is giving more functionality to UI, UX, and the usability of that product, the person who's going to use. That means to do that, the cost is again going to be really very high, right? And third aspect is if you want to look at the most cheapest product, then it may not be again that secure. It may be again complex. So that's where the security dilemma is. So it is really important that you, I mean, the only way to come out of this dilemma is that you can focus on only two. You can focus on cost and ease of use and security, and you spend more money of it. Okay, that will be what you should be looking at. So to come out of this dilemma, another way is that you focus on the risk-based approach, and this is what exactly Huzeifa ji spoke in his slides also, that what is really very important for the business, how it's going to affect my business, if and it's about understanding what is the threat landscape and map those threat landscapes and how it is going to affect the business. So see, in fact, we have been doing this for a lot of our organizations where we tell the customers that this is what your threat landscape is, this is what your risk which is there. And we help them convert that cyber risk into a financial risk and show them that this is what your financial impact will be if you face a cyber attack, right? And tell them that this is, so once you are able to convert your cyber risk into tangible figures, right? That's where, it's easier to map and understand, okay, now this is where my business is going to get affected. I cannot or no way I can afford to have $1 million cyber exposure because of this particular risk. So it's better I put a control there, okay, and I implement. And that's where it is easier to give out funds as well, or recommend a specific technology which helps you reduce that risk in your organization. So a risk management approach is the most important approach any organization should really focus on. It doesn't matter how large or how small that particular organization is. So any questions till now till we move ahead? Okay, fine. Okay, let me move on. So as an internal auditors, right, as rightly said, right, we should be focusing on a risk management approach, right? What is the need in the today's organizations, that is internal auditors and IT professionals and security professionals, we should be focusing on, right? We need to focus to manage people's and process risk, right? There is a current, and whenever there is an adoption of a disruptive technology, there's a change in the approval authorization mechanism, right? There's a disruption in business processes. As an internal auditor, you should be able to identify those risks and map it with the business processes and identify what can be the potential impact that will happen on organizations. This is what an internal auditor should focus on. Again, any kind of disruption is coming into a picture of if you're onboarding any kind of a disruptive technology, which is really going to change the way you do a business in an organization. It is really, really very important that what will be an applicable cyber risk. Is it or the technology is enough secure or not to make sure that you do not get affected? Because today, if you are onboarding any kind of cybersecurity technology or an innovative technology, important aspect is, are you being, are you being part of a technology which is vulnerable in nature, though it is providing a really great value. But because you're going to onboard it, you are also becoming equally vulnerable to a cyber attack, right? Another important aspect is impersonation. Now, when we are having a process in an organization, right, we trust the process. But how would anyone know that, it's the same person who is doing that activity and not anyone else, right? That's where the impersonation risk is a lot which internal auditor should be really focused on to, to be aware of, right? Now, again, when I talk about impersonations, right, it can be inside the organization, outside the organization. Right? You may have asked somebody to, do certain activity. Is it the same person who is doing that activity inside the organization? If no, who else? Is it an automated process? Is it some malware which is running? Okay. Impersonations not only happen in the organization, it can happen outside the organization. Somebody just picks a copy or creates a copy of your internet banking site and then just put it in the internet. people and send a link. Okay, if you want to now, this is our new address. You can now log in into your bank account through this address, and it is just marketed. It takes couple of money, a couple of rupees just to do that, right? And that's where imposing attack on an organization is really disruptive for the businesses. It affects the brand image of the organization. Business email compromise. We have seen cases, many cases across the organizations where a CFO or a CEO is on a leave or is on a vacation and immediately gets a email to accounts department. Hey, I'm stuck here. I need payments, and you immediately transfer so and so amount to me or to this particular person, and I'll refund you whenever then. And the employee of an organization will not dare to challenge it. Do we have that processes in place so that it will we have checks and balances in place? As an internal auditor, you should be really able to identify such situations, right? Cyber unaware. Now, whichever new technology is coming to picture, right? If there is not enough awareness in about that technology of adopting it, your disruption or disruptive onboard technology onboarding is never going to happen. Okay, along with creating a cyber awareness in the organization, it's also equally important that we create awareness about any new technology and enough awareness so that the onboarding of those risks or those technologies can happen. Okay, brand impersonations we talked about. It can happen on social media. It can happen on recruitment campaigns, right? So this is what the impersonation risk also, as an internal auditor, you should be aware of. Okay. Another important aspect and opportunity which is there in because of the cyber risk, right, is that of course we have internal audits in place, but we also need to have a governance, risk, and compliance committee very clearly, which will help you understand that whatever you have deployed as a security perspective or a process perspective, is it really required or not? Now there are two committees which is there. One is somebody which is going to recommend that this is really required, and once you have implemented it, okay, this is time where you evaluate and keep on checking that are we really achieving our goals which we have thought of. It's not about you're questioning the person who is really recommended that technology or a security function or a control, but is it working as it is required? Okay, are we achieving our goals because of that? Check the effectiveness. As an internal auditor, it is really very important that whatever security controls you have procured, okay, or processes you have implemented, is it really showing effectiveness in the businesses? Okay, is it really changing the way you do businesses, right? So the effectiveness of those controls is really very important to understand. You also need to align that are the security controls in line with what your regulatory or a local or legal asks are, right? That is again important to know. You need to also need to check about are we doing any kind of if we are onboarding any disruptive technology or any innovation, is it complying to the laws of the land? You may be a country which may be operating in multiple locations. Just very simple example. Any mobile phones which are being manufactured or designed out of US, okay, those mobile phones will not have recording feature. But if we talk about mobile phones which are outside US or which are designed or manufactured outside US, or the companies are not headquartered for those mobile phones, will have a recording feature. Now, this is one of the legal compliance that US does not allow recording of any personal information or a communication without prior consent. It also comes about from the privacy income. We'll look into that in the future slides. But other countries do not have that specific compliance norms, and that's where it is allowed, right? So as an organization, you really need to comply to the local laws of the country as well, right? We also need to make sure as an internal auditor that when you're talking about the cyber risk, where does your bug stop? Okay, ultimately, it's not the security team who looks into it, who is responsible for any kind of cyber attacks. It is all about the management and the alignment to their business objectives who are responsible. The business heads are responsible accordingly, right? They are responsible to protect the reputation of their organization, because they are the people who are really running the business. They are the people, sorry, who are capturing the market, right? So everything outside the security or cybersecurity affects cybersecurity of an organization. What does it mean is that as a cybersecurity, you may be implementing a lot of things, but that's not enough, because what happens is that you really need to identify as as an internal auditor that as an auditor, you really need to identify that that particular control has to be there, or whatever business change which is happening, okay, how much it is affecting the security of the organization, right? uh, just 5 more minutes, I've got something to cover on privacy, right? So just to understand what is privacy is all about, it is a right to be left alone. Now in India, it's still building it up, we have still coming up, but traditionally when we talk about security and privacy, just a second, when we talk about traditional about security and privacy, security is about protecting things, not allowing data to go outside your organization. But when we talk about privacy, we are also talking about not only the protection, but we also talk about who has an access to what, for how long it has an access. That's what the privacy is. Across the globe, we have GDPR is well known for the European Union. If you breach any kind of GDPR privacy laws, you are responsible to, you are supposed to be penalized. I would say 4% of the your global turnover, or it's a couple of $1 million is what the penalty clause is. Now in US, there is no specific standardized privacy law. One of the known ones are California Consumer Privacy Act, but every state in US has different privacy laws, right? They are working right now to have a federal privacy laws. Canada has its own privacy law, right? We are talking about Brazil. They have come up with their general data protection law. China has already come up with privacy law in 2020. In Canada has also come up with the Privacy Protection Act. India, we are talking about PDP, which was tabled in 2019. We have been working on this law from quite some time now. There's an immense opportunities for us in privacy, because because every country has a different privacy law. So as an internal auditor, if your company is into different geographies, you have to understand the privacy law of that particular country before you apply it on your organization. Okay. Unlike security, though security is applicable for every organization, but smaller organizations today, a very small organization, I'm talking about 5 to 10 user companies, they tend to give it a mess, right? But it applies for privacy. It is not that. Even a single user company, a single grocery shop having a computer is applicable for a privacy law, right? Basic parameters across, it may be different in different countries, but what are the basic parameters that as a user you have a right to be forgotten. So if I'm giving my data to anybody or any company, right, I have a right to be forgotten. I can really fix that. If somebody is using my data, it should be only for that purpose for which they have collected, and it has to be consent-based collection. Okay. I have a complete right. I can clearly say now, in fact, the today's phones are really very advanced, which allows you to being tracked or not tracked. There are browsers which are there, which will not track you out. Okay. So that's where the privacy comes into picture. You as an organization has to be equally aware that how much you are tracking your users or not, right? Another, we talk about a consent-based collection. So you must have seen today in browsers, whenever you access any website, you get a notification, okay, we will be tracking your data. Now, if for a larger companies, for any company, you need to have that consent recorded, that this particular user of so-and-so IP of so-and-so laptop, okay, we have got a consent that we can access everything, or we can utilize this data if that person has added the data to the system. And you have to manage those consents, okay, for a longer time. So if that person realizes tomorrow that, okay, I've given my data to this particular organization, and send it across to them, you have to make sure that the user can demand that please remove my data. You have to remove that data and give him a proof that yes, we have removed with a proper declaration. Now, these are the processes which has to be there from a privacy angle. And as an internal auditor, if you are looking from a perspective that to have privacy structure in the organization, there are a lot of opportunities which is coming up. And when we talk about balancing all this privacy risk, cyber risk, the risks which are coming up with the disruptive technologies, the only approach is that listen to the businesses, understand what business wants, what what are the business want, how we can really protect business and execute it. We cannot focus on any standard. You may be an ISO 27001 compliant, you may be under regulatory mandate. If it is not helping business, your cybersecurity or privacy is of no use, right? So ultimately, the balance is only about focus on businesses and apply cybersecurity controls or privacy controls accordingly. Is what the balance is all about. Ultimately, it's important that we secure IT. And if there is any questions, I'm here to take.
Thanks, Ajay. The word cyber threat is here to stay.
That's true.
I am sure that's everyone has accepted that as a part of the secure and find a way out to protect from all those cyber attacks that happen unknowingly, unknowingly. However, I mean, our dependency on the digital world, on the technology has increased fourfold over a period of time, and especially in the last 2 years, where things or accessibility to things physically were nearly impossible. So with, not only audit, I think in your personal capacity, each professional needs to upskill themselves when it comes to cyber risk, because directly, indirectly, somewhere we all are involved or are a part of process, and it somewhere becomes our responsibility as well to ensure that we mitigate those risks as far as possible. So upskilling or a knowledge or having some kind of basics on the cybersecurity is essential for each one of us to implement in our professional life, as well as on the personal front as well, because there have been instances where there were malwares and viruses which were installed in the smartphones which each one of use, and there were instances where those passwords and all the data were taken. And apparently most of us use so many apps without reading those terms and conditions.
That's right.
We blindly give accept all terms and conditions, and we don't know what data is shared, including our contacts, the locations. So yes, we need to be more vigilant about the kind of data, and we need to acknowledge the fact that yes, as you said, cyber threat is real and it's here to stay. So the only way out is to be more secured, or to be more vigilant about things and ensure that we take adequate precautionary steps as far as possible. But as it goes, that the person who does the mischief would always be 2 steps ahead.
That's true. That's true.
Sure, Ajay. Thank you. It was pleasant
Thanks a lot.
hearing
Thanks a
you
lot,
out
Kalpesh,
with all
for
the
inviting.
details.
Yeah.
Sure.
Thanks a lot
Thank
for
you.
inviting, Kalpesh. Thanks a lot, man.
Yeah.
Bye.
May I now request Rahul, our next speaker for the session. If you could just introduce Rahul.
Kalpesh, I think the introduction was with you. So, I think if you could quickly introduce Rahul, and then, maybe the floor can be
I'll do
yours.
that. I'll do that.
Yeah, sure.
So yeah, our next session on the operational risk management, an interesting one, continuing with the existing cyber threat. And let me take this opportunity to welcome Rahul for this wonderful session. And I'm sure at the end of the session, each one of us would be enlightened with so much of practical experience, looking things from a different perspective. So just a quick intro about Rahul. So Rahul is currently the Managing Director of Productivity Financial Services in India. He is a chartered accountant and a GAP certified FRM professional. He has more than 17 years of experience in internal audit, risk management, and compliance across various financial services industry. He has led a large business and risk consulting projects, including operational risk framework, business process improvement, internal audits, model risk, etc. He is a well-known speaker across all forums and has been a regular one on various forums like IIA, IIBF, and ICAI as well. So, on behalf of IIA Bombay chapter, I take this opportunity to welcome Rahul for this wonderful session. Rahul, all yours. The stage is all yours. You may continue with.
Thanks a lot, Kalpesh. Thank you. Thanks for the warm welcome. And thank you so much for the opportunity. I'm just sharing my screen and just let me know if the same is visible.
Yes.
Perfect. Thanks, Ajay. Yeah, I know it was afternoon when we started and now it's a Saturday evening. I do understand that people would have their plans. I'll also try and make sure that we wind up as per the schedule what we have. I do understand that there are varied level of audience, which is like somebody who have a basic understanding about the banking, and there are experts as well. So I'll try and make it a balanced way during my presentation also. So there are two aspects mentioned in the subject, right? Operational risk management in financial services and entities. Let's first break down the two. If you have to start with the operational risk, and I'm sure at least some of you would have seen a movie called Runway 34, and one of the incident happened, and one of the dialogue or one of the scene in the movie was there where the person who was supposed to transmit the information relating to the weather was not keeping well, and they could not inform the situation to the aircraft, right? It's a people risk which got driven, and because of which the certain other things also happened. Yeah, there were other reasons as well, I do understand, but yeah, this was also one of the factor which kind of created that particular situation. And I kind of love an aviation industry as well, and I do follow a lot of series, web series and other stuffs where they kind of decipher or kind to do a root cause analysis of any kind of an air crash, right? And once you notice, if you look at a lot of such episodes, you would realize that there was either a failure of a system, or there was a miscommunication between the air traffic control and the aircraft, or there was some negligence of a skilled pilots as well. Sometimes that happens, because of which those crashes have happened, right? So an operational risk is something, and we'll go to the definition as well, which Basel and RBI kind of details about, but more to do with the fact that what kind of damage it can create. And a life loss is the biggest damage, right? I mean, you can lose money, you can lose some property or some of the other thing, but the loss of a life is the biggest loss which can happen, and that also can be caused because of an operational risk failure, right? So that's how the extreme end of an operational risk can be looked at. Now let's look at the financial services entities. And in my 17 years of career, I have always worked in financial services industries across banks, NBFCs, stockbrokers, capital markets, stock exchanges, insurance as well. Honestly speaking, as a financial services sector, we do not grow anything, right? We don't do any kind of agricultural activity where we are producing anything. We are not manufacturers where we mix two materials and produce or create something out of it. We neither construct, but honestly speaking, we facilitate each and every industry which is there. We kind of know and understand each industry. We produce the research reports, so to call it as, for each and every industry. we underwrite them, right? When we are giving credit to any of the industry, we literally underwrite them. We understand that particular industry, that particular company, and then we kind of lend money. To exceed further, we even underwrite life, right? There are life insurance which as a financial services industry cater to. So that is what the overall financial services industry all about, which right spans from traditional banks, commercial banks, to the fintechs today, on the lending side, on the investment side, on the trading side. Insurance is an area where we kind of financial services exist. Now let's mix or a blend the two, right? And it's an era of mixing and blending. So let's mix the two: operational risk management in the financial services entities. And just to start off with, these are some old dated events, but yeah, they still kind of whenever we speak about an operational risk in the financial services industry, these are the top events which anybody would kind of try to recall. And I've just mentioned few of them. There are multiple of such things which have happened in the past because of the operational risk related issues. Segregation of duty, right? So there was an incident of one of a very large investment bank where the trader was having an access to the back office accounts as well, right? So he would do some trades, but make sure that those trades are not accounted in the trading system. He was a very known trader. In fact, he was very reliable person of the CEO as well. He made a lot of profits for the company at the initial stages. However, he suddenly started facing certain loss-making deals, and he didn't wanted to show this to the management. So that's why he was hiding it. He thought and he believed that over a period of couple of weeks, he'll be able to recover that loss and come back to the normal situation. However, that didn't happen. The loss kept on increasing, and suddenly when the overall settlement had to happen, at that time, the bank didn't have money to settle the transaction with the counterparty, right? So kind of a trusted person in an organization. He wanted to, the intentions were good, the faith was there, but he couldn't do. And ultimately, if you figure out the reason, there was a clearly an operational risk period. There was no segregation of duty between the people who are doing the business, which is the front end, which is doing the trading activities, and the settlement related stuff, which is the back office activity. Similarly, there was one more interesting case of exceeding the risk limits, right? This I've just kind of mentioned the causes as well. This was the first one of more on the people issue. Exceeding the risk limit was somewhere where there were clearly defined limits in terms of what is a position in a particular sector or in a particular script or in a particular currency one can take. However, the same were not followed. And there were system lapses, there were system alerts which were coming up, but then they were diverted or diluged in order to pass through and continue those positions or limits. Ultimately, again, the bank had to file a bankruptcy. To that extent, it went. So just some of the events which have happened in the financial services, kind of because of the operational risk. And now, if we go a little back, so in 1998, when Basel I, 1988, when the Basel I came, the way the risk were viewed by them was there are a lot of business risk of doing a banking services, right? And that is how the risk was defined. Then slowly they realized the major risk is the credit risk, because that's where the traditionally and even today, I mean, major income for any bank would be to earn from the interest income of lending, right? So they realized the credit risk is a separate risk, and they started categorizing it, identifying it, monitoring, measuring it, etc., etc. In 95, they realized that there is also a market risk, because as a bank, you kind of have to make sure that you are maintaining those ratios, you are doing those additional funds are invested, you're doing borrowings to make sure that your balance sheet size grows up and you're able to expand. So they realize that there is a market risk. And at that point of time, the way operational risk was defined is anything not to do with the credit and a market risk is an operational risk. So it was a negative definition. All other risks which are not a credit or a market are an operational risk, because you can anyways identify a credit risk will happen only in a lending space, right? It's not going to happen in your deposit business. Similarly, the market risk is clearly there in your treasury function, but it's not going to be there in your payments business. So that's why that is how they were viewing it. But slowly and suddenly they started realizing that a lot of credit risk and market risk which was happening was ideally because of an operational risk failure. So a very simple, straightforward example of a fat finger error, right? It's a, instead of punching a trade for a 10 lakh, you punched it for a crore or maybe 10 crore. And obviously you ended up taking a large market risk position, but that has happened because of a failure of a system control which restricts a particular order. It was not controlling that. So that's where in 2004, Basel realized the significance and importance of an operational risk, and they introduced the third risk as an operational risk. And what is a residual risk? Anything then other three risks, which is a strategic and a reputational risk, was identified as a residual risk. Now, what is the definition which Basel came up with for an operational risk? Is defined as the risk of loss because of either failed processes, people, system, or from external events. So these are the four major components which are defined, and we'll shortly speak about all four of them. But the legal risk is included in the operational risk definition. The strategic and reputational risk are considered as a residual risk, and they are outside the definition of either credit market or an operational risk. So I hope the definition part is clear. So quickly moving on, so we realize that there are four components: people, process, system, and external events. And I'm not going to call each and every one out of here, but I'll just pick and choose and try and take some examples from it, so which helps us understand why certain thing happened. So a typical people issue in terms of a maker checker control failure. If I'm not if even though I have put those maker checker control, but I've not performed it well, or there was a system through which it got bypassed, and unfortunately an entry got posted in my particular core banking system which should not have got posted. So that's a people related aspect to it. Improper project planning from a process standpoint. So process means either you have to have a defined policies, procedures, there's a segregation of duties, a clear standard operating procedure is available which defines what needs to be done, by whom, how. There's a detailed particular aspects of each and every activity which is mentioned in your standard operating procedures. Improper project planning would mean that ideally a project is a risk, a business risk, right? But if I know at the beginning itself I have not done a proper planning, then you cannot call it as a business risk. It becomes a part of an operational risk. System related stuff, we just spoke about a fat finger error, or maybe even when Ajay was mentioning about a lot of cybersecurity related stuff, these are all kind of an IT securities issues which kind of ultimately leads to an operational risk. External events, I mean, prides or maybe natural calamities, those are the part of external events which have been defined in the operational risk. Legal risk is kind of it can happen because of any of these factors, but what does it comprises because is something like a contract drafting errors and a thing which I should have claimed rightfully, I'm not able to claim that. So those are the kind of aspects which are defined in a legal risk. I'm just trying to move quickly because these are very basics of the operational risk. Maybe we'll spend more time in terms of what does a next gen operational risk all talks about. Again, a very standard kind of a content, if I have to call it, as any risk life cycle for the credit market or an operational, the typical life cycle is to have a governance around it, the identification of that particular risk, either credit market or operational, as I said, the assessment of it, the measurement in an operational risk is not so so advanced or so mature as compared to a credit or a market, hence it does not feature here. But yeah, there are measurements as well for an operational risk. But yeah, the typical life cycle in terms of identification, assessment, measurement, mitigation, and finally monitoring and reporting, right? So from an ORM standpoint, the what we have done is just what is an objective of that particular component, who is responsible for that, what kind of infrastructure or a setup we need, and how frequently that needs to be done. So that's something we have kind of tried to mention in this particular slide. So now governance is something needs to be as even for the RBI exercise, when Huzeifa was mentioning that there has to be RBI policy which has to be approved by the audit committee. Similarly, an operational risk framework needs to be approved by the operational risk committee of the particular bank, and that defines clearly what is the strategy, what are the authorities, roles and responsibilities, etc. Identification is to identify the inherent risk in each of the processes which are there in the existing in the bank. Controls are then to be mapped against each of those risks and then categorize them. Assessment stance is more from a high, medium, and low, which is more dependent on the impact of that particular risk and the frequency of that particular risk. Ultimately, we do a control assessment to come up with the residual risk. That's how the standard typical operational risk would work like. And in order to monitor, there are additional measures available in terms of the KRIs, which are the key risk indicators, which kind of flags off that, let's say, for example, if the customer complaints generally ranges between 1 to 10, but suddenly in a month, I see a 50 complaint, then there is some failure which would have happened either at a sales end or maybe in delivering a particular operational activity, right? So that's why the number of complaints have increased. So those are kind of indicators which helps me kind of divulging more into in terms of identifying where something has gone wrong. Incident loss data reporting is also a key mechanism in the overall operational risk. Events will happen, near misses will happen. It's important to learn from them. So in order to learn from them, we need to create a repository of the same. Entire organization should be encouraged to present those particular scenarios upwards and inform to the second line, the operational risk team, that something like this has happened. Generally, the loss events would get reported because it has a financial loss attached to it, but the incident or a near misses sometimes get missed out to report. The near misses are where are the situations where at the last moment I was able to control it and the loss actually didn't occur. But those are also key learnings for us to avoid future losses. So that's what the traditional operational risk has been. And moving on to the kind of conversation which Huzeifa and Ajay also did in terms of the entire revolution, what has happened in the overall financial services industries. And we'll talk more about it in terms of the altered business model, which is where I want to focus on. We kind of call it them as the altered business model, which is what is driving the change today. And frankly speaking, whether you look at the risk and control from a third line perspective or the second line perspective, they are going to remain the same. Ultimately, the risk and control in an organization are same. It's just the lens and the mandate what you have in the third line and the second line, right? I understand that the earlier two sessions were more focused on the internal audit side, but this is on the operational risk. But there are 2 points which I just wanted to mention. One of which was, as I said, it's the risk and controls would ideally remain same. It's just the lens through which you look at it, either in an operational risk or an internal audit. And also, banks' internal audit are supposed to mandatorily do an internal audit in a set frequency of the operational risk team as well. How the operational risk team is performing their roles and responsibilities, which are defined in the RBI circular. So these are the 2 important elements from the audit standpoint, which I want to talk about. Now, I'll begin with the entire, all these words everyone has seen, everyone has heard, and everyone understands as well to an extent, right? So these are something which has kind of created changes. They were forced in our entire last 4 to 5 years because of many aspects, demon, then because of the COVID, all of these things started impacting us. Cost saving was another important aspect attached to it. So what are the altered business model? So an altered business model would mean a model where, either you completely change your existing model or you make those small changes because of which your entire experience of delivering a product or a services change. And some of the models which I've just kind of mentioned here, a platform banking, it's kind of a potential neobank or a subsidiary of the organization. So for example, Kotak 811 or an SBI Yono app are some of the examples of a platform banking where a complete digital service is available on that particular platform, right? Digital only. So a lot of startups and fintechs in terms of the lending or in terms of the payments, or even for that matter, credit cards and debit cards, prepaid cards are digital only. There is an app which you need to download from a Play Store, update your mobile number, they will verify it, put your certain basic details, they will cross-verify your Aadhaar, PAN card, everything online, and within 5 minutes, half an hour, or depending on the kind of a product and an entity you're dealing with, they will complete your transaction either in terms of a lending or issuing a debit or a credit card to you or giving an insurance to you, right? So that's what the altered business model is. Non-linear models or unbundling the traditional products, which means the existing products are kind of reshuffled in a manner, are customized in a manner which are more required for today's generation. Now, why this happened? Causes of an altered business model, if I have to really say that. There were obviously defects in the original model, right? They were not customized. They were made for large audience. So when you look at a bank, a large bank, you would imagine their same saving bank or a current bank or the same term loan product or a same housing loan product is available for the entire nation. The same kind of application form or a processing is happening in south of India or in a north of India. So that was a key. There were some defects in that particular original model. There were new revenue opportunities which were available. This modified way of customized way of doing models was bringing more business, was cost effective, and hence it was bringing new revenue opportunities. Even from the value proposition perspective, it was benefiting the customers from using those services and products. So overall, net, this is some of the reasons why this altered business model came into picture, and some of the just examples I've mentioned below. Moving on quickly, how? I mean, where they are doing this altered business models are getting used. A payment, right? I mean, we would generally, very, very traditionally, we would go to the bank to make any foreign transaction payment or remittances, right? But it's no longer the case. Again, an app can really do an end-to-end transfer for you sitting at home. Deposit and lending. I'm sure everyone has heard of a P2P lending, which is peer-to-peer lending. And that kind of a platform brings together the small savers, the people who want to do a small savings, and the people who want to take the small loans as well, right? So deposit and lending is a space where, again, the altered business models have kind of played a big role. Similarly, specifically on the lending side as well, as I said, the personal loans or the education loans, there are a lot of companies who do this end-to-end digitized way of lending. Your agreements and everything gets the geotagging is happening to know where are you located, and make sure that the negative listing is screened out or ruled out. Similarly, your photos are taken, the photos are matched with your Aadhaar card, and up to a certain extent, if they are okay, then they will proceed, otherwise they will reject the case. So there are multiple models which are helping in terms of doing these businesses. Investment management. So traditionally, again, a kind of a wealth manager would come to your home, understand your risk, understand your appetite, what are your goals, and then kind of give a solution to you in terms of this is how you should invest. This much should be equity, this much should be debt, this much should be in the fixed deposit, etc. Whereas this is again an area where you provide your details on an online platform. They'll come up with the specific solutions, and then they will go more detail in terms of how you proceed with it. Ease of raising capital. I mean, this is the most amazing part of it, right? I mean, there are so many disruption happening across each types of businesses. You can also, for doing those businesses, raise capital through platforms. So there are platforms available for even to raise your capital. Now, what kind of opportunities these altered business products or the models bring? Obviously, the biggest advantage is a financial inclusion, right? I mean, banks will have, or any particular organization for that matter, be it of the highest market capital organization in India, the reach is limited. You cannot reach each and every street, you cannot reach each and every village of a country. But with the applications, you can really reach each and every place. So ability of the people who are not living in the tier 1, tier 2, or 3 for that matter cities to participate in the overall financial system of the country becomes very easy. As I said, there are more tailored products which are available. The cost is reducing because there are no branches, there's no real estate involved. The people are also required to run the altered business model are relatively less. Where other places we are seeing the demand for the altered business way is the reg tech. Kind of your end-to-end regulator reporting can happen through a platform, right? So again, the error of a mistake is less there, and similarly at the same time you are saving on the overall people or the FT which is required to process those particular regulatory returns. So net, these are some of the opportunities which are there because of the altered business model. Now, everything looked so rosy, everything looked so good so far, right? But the moment there is a digital or there is this kind of a fintechs which have come up, they have also brought some additional risk along with that. And this is just one of example, I just wanted to make sure that we show some data to you. The number of complaints received overall in the year financial year 19 vis-a-vis 20 increased more than 50%. So that's number one data point. And interestingly, the 45% of the complaints were related to the digital services, which is either an ATM debit card or a mobile electronic banking or a credit card. So obviously we can easily understand who is contributing to these additional complaints. Yes, I mean, this doing the way the which benefits the customer, the lowers the cost, there are revenue opportunities, but at the same time, certain things are happening. I mean, operational risk was always there, right? I mean, I started off with the definition which happened in 2004. The operational risk management in every bank existed, but this disruption as no, I mean, operational risk need to get up to make sure that they are able to catch up with that and understand it better and manage it better rather. Some of the other challenges which operational risk has, which I just wanted to make it, as I mentioned initially as well, the credit risk is only in the lending space, the market risk is only in the treasury space, but the operational risk is everywhere. You do an HR or an admin, I mean, there is a CCTV camera failure in a branch is also an operational risk, right? I mean, so it can go down, the number of scenarios, the number of places this can happen is humongous. Each and every aspect of your business has an operational risk attached to it. There are dozens and diverse types of risk which are there, right? In addition, the new risk which are there, I mean, we do have a separate compliance function, separate financial crime function, cybersecurity, cyber risk is there, then IT risk is there, but there's no clear distinguishing lines between what is managed by an operational risk and what is managed by a compliance is not there. And just to make this a little more elaborative, we all understand the heaviest, most regulated industry in any country would be a financial services industry. SEBI goes down to an extent that what should be mentioned in your contract note, how much maximum brokerage you can charge, for how long client money you can keep with you. So there are very, very detailed regulations which are prescribed, and they are going to an extent the way you operate your business. In fact, standard operating procedures, if you look at the 60-70% of it will be filled with the compliance requirements. Hence, it becomes all the more important for us to distinguish what is the responsibility of a compliance and what is the responsibility of an operational risk function. Otherwise, there'll be always something which will get lapsed between the two. Even similarly for a cyber risk, ultimately it's an overall category within the operational risk under which the cyber risk or a fraud or an IT or a financial crime would come. But having a clarity between who is responsible for what is very important. As of now, it is not fully clear, so to call it as. So yeah, that's what I just wanted to present through this slide in terms of the change is happening, but that also needs an upliftment from an overall operational risk standpoint. What are the key challenges as of now, if you look at it from an operational risk standpoint, is the identification of the operational risk is happening more on a silo based. So I'm looking just at a treasury as a function. I'm looking at their processes, the manual processes which they do, and then basis that I kind of design on a risk control matrix and do my identification. But that's not going to help us. When we speak about the next gen slides very shortly after this, we'll cover some of the additional points which we need to do. But it's more important here to understand that an particular event in a particular function can also trigger some of the other potential risk in other functions. They cannot be looked at in silos. I'll pick up the third one, absence of a risk data mart. Obviously, the banks have evolved, right? I mean, in any bank you say, any large bank you name it, maybe 20, 30, 40 years in existence in the country. Hence, what happens is that they started off with a particular product and a particular system at the beginning. Then they launched additional product and additional system. After that, there were few additions happened in the system. Then again, they tried to combine all the systems together, but it might have worked, it might have failed. Again, there would be a separate accounting system. A new product came and everybody is using a new system, so I'm also taking that system. So there are multiple systems which are there in the bank to service different products and services. And ultimately what happens, everybody is not giving a particular data in a particular format to be processed from the risk angle. There are different versions of the risk which are available with everybody in an organization, which leads to confusion, and it becomes more problem for an operational risk function to understand where do I start from. So some of the key challenges which I just spoke about, I just want to spend some more time, and there are a lot of failures which are mentioned here below. I'll pick up some of them as well while we speak about, but some of the evolving risk landscape which we'll have to call, and which I think Ajay also spoke about, is the online hacking and the malware attacks which happen. So Swift as an infrastructure is used widely for making all the payments, right? I mean, if you attack that, then the whole financial systems can go down for a toss. The application security risk, I mean, there are, again, we spoke about the digital only kind of altered business model, right? Which is happening only and only through system. Now, in this case, the application, if the application security breaches, then the entire model goes for a toss. Just to take an example from the below, I think one of the large bank, Mizuho Bank, had a data glitch, and because of which 80% of the bank's cash machines were down, and it lasted for almost 24 hours. And it's a huge risk if you really look at it, a non-availability of your system, of such a critical system for 24 hours. Similarly, money laundering risk, I mean, cryptocurrency has also kind of played a role here. The same is not regulated across multiple countries, but still some of the payment gateways uses them as a formal payment mechanism. So ultimately, you're not able to identify from where this particular money has come, and which obviously results into a money laundering and a terrorist financing kind of a risk. New encryption technologies, blockchain, it again sounds good, but then the moment there are hackings which happens on the entire blockchain mechanism, then it is completely run on a trust business, right? So if you believe that this particular source is coming correct to you, then you will accept it as a payment, whereas then later on you would realize that this payment was never there. It's a huge risk which banks faces. Again, I'll pick up one case from below, and these are the top 5 publicly reported fraud losses for 2021. And just look at the number of, I mean, look at the value itself, right? Like the NY Group faced $1.23 billion kind of a loss because it was defrauded by the former director, involving fake deals and forged contracts. So it was heavy loss for them to face off with. Digital identity is another kind of an evolving risk which we should understand. It's all about, right? So we send a lot of OTPs and the codes, secured password through phone, but the moment they get hacked or they are able to decode it, it brings a huge digital identity risk. I mean, the bank would believe that they are dealing with Rahul Zaveri, but ultimately they are not dealing with him. They are dealing with someone else. Cloud-based securities, in order to make the things more efficient and make more 24/7 availability, we approach cloud, right? But then that also, as Ajay was explaining, it's the same platform where you are uploading, downloading, so it does bring those risks. Upstocks, everybody know, April 21, they had a huge breach of their KYC data. Similarly, JustPay also lost 35 million customer data, Mastercard data, card fingerprints were taken from a server by an unencrypted access key, right? So a very huge sensitive loss of a data. It obviously brings privacy related stuff, but it also brings direct financial loss to the banks. So I'll just take a quick pause here. If there are any questions, happy to address that. I just have a last 4 slides, which we'll talk about from the next gen ORM perspective, and happy to take additional questions later on. yeah, if there are any questions, happy to address.
Anyone have questions can be asked directly.
Thanks, Saurabh. I think we'll move on.
Yes.
So we'll look at the same thing. I mean, the next gen ORM is, so the operational risk basic concepts are not going to change, right? At the end of the day, as I said, the risk assessment life cycle is still going to remain the same in terms of the identification, assessment, measurement, monitoring, reporting, mitigating, right? So it's the same thing, but there are certain additional aspects which are which we believe can help organization to understand what changes happened and how best they can overall, support the business function. And in fact, as Ajay said earlier, the frameworks or whatever controls you bring in, they are ultimately there to bring value to the business. Then only it'll get accepted. So now let's look at all the 7 steps and identify what are the additional stuffs which we'll do. We have been always doing map the processes along with the risk and controls, right? But we also need to at the same time now look at it. What is the level of complexity involved in that particular process? What are number of handoff involved in that particular process? Try and capture this information in itself in your risk and control matrices in order to understand the impact of the overall risk, right? Also, we would traditionally focus more on the processes which are driven manually. But now one should look at it end to end, that what is happening exactly in the system, even capture that in your risk control metric so that it gives you an end-to-end life cycle of the entire transaction, and identify what is happening through automated process and where we are relying on a manual processes. So that's the first activity which we need to do. And again, it kind of brings to the second activity, that understand points where the process relies on the technology, because those are also needs to be something which documented. Monitor risk and controls. It kind of, again, in a very simple way, that we need to understand each and every risk and monitor through them control. But the important change here is, wherever possible, we should do this on a real-time basis. If you're going to do this after a day, end of a day, or maybe after a particular quarter or something, it's too late. It's just going to create a huge, humongous problem, and it'll just keep on adding to the pile up, what we call it as. So it's very important to do it on a real-time basis. The fourth important aspect is link resource planning. So we all know that there will be times where the volumes will be higher. There will be downtimes as well. So we need to understand what kind of strength we have to process a particular volume and support in case there are large volumes. And at the same time, we don't want to keep a bench to add cost to the business, right? So there has to be a fine balance, and the same needs to be discussed and deliberated with the business to come up with a clear resource plan for each and every activity. Training by default, it's a standard one. We need to reinforce the same. Enabling feedback, I also spoke about that. We need to encourage each and every person in the organization to come up and talk about or report a particular incident or a near miss or a loss, because that is where the learnings will happen, the root cause analysis can happen, and we'll be able to better prepared next time. Establish a change management. We need to make sure that we understand the entire ongoing change management process. We have right talent in place. We do test those processes in capacity and make sure if there is a requirement of any change management, we are able to do it swiftly. Obviously, we need to use advanced. There are some questions, but maybe I'll just take it up after. There are just 2 or 3 more slides, and we can take up all together. Use advanced analytics. Now, there are some areas which we have mentioned here, which can be looked at from the overall perspective, right? So AML standpoint, a lot of organizations have a huge team size in monitoring the AML alerts which are generated by the system. However, if you really look at understand the patterns and everything, maybe 80% or more than that are false positive. If you refine or relook at your rules, you're able to reduce that particular strength and use it somewhere else more effectively. So looking at the false positive and analyzing them through the advanced analytics tools can help you in terms of managing your operational risk well. Similarly, cyber risk, identifying the sources from where the threats are coming and accordingly working on that, again, reduces the false positive alerts. Conduct risk is again a very important element in the overall banking system, right? At the end of the day, we are not the mis-selling is a very strict regulation. Mis-selling can happen in terms of either selling a wrong product to a wrong customer. So understanding the risk profile of the customer and then selling is important. Making sure that he or she understand what product they are getting into. Now, if you suddenly see a trend and if you're able to map it, that there's huge increase in a particular product usage in a particular area or by a particular function, because the incentives are driven accordingly, and 2 months down the line there are a lot of customer complaints, and obviously you're able to correlate using the advanced analytics and curb them. So the operational risk need not be viewed only limited from the process related events, but then there are various ways to identify the operational risk and do more benefit to the organization. There are a lot of outsourcing which happens in any bank. Obviously, as a bank, you don't want to run into multiple activities. It makes sense for certain organization to centrally drive for various banks. Just for an example, ATM. So the ATM installation, the cash replenishment in the machine, everything is done by outsourced agencies, right? They do it for multiple banks, so they are able to do it cost effectively. But what it brings is an operational risk from a third party angle for a bank. So again, that needs to be monitored carefully. And when you are drafting your process risk and control metrics, you need to look at it end to end. The way I said at the beginning, it's not that if a particular thing is done by a technology or a system, a transaction has to be viewed in its entirety. Similarly, it doesn't matter that it is done by a bank or a third party. It has to be viewed in its entirety. Obviously, we need to have talent to run this particular to understand these new types of risk and able to monitor and measure and mitigate them. So we need people who have cyber risk background. We need people who have fraud risk background and a conduct risk background to make sure that we uplift our overall operational risk team. Just moving on to the last part of the last slide of the entire presentation. Human factor risk is again very important. They are linked with culture, personal motives, and incentives, right? They are everywhere in an organization, in each and every process, and each and every infrastructure. We as humans are motivated by incentives, so the incentives have to be done in a manner which cultivates the risk culture. The first step is, as in any organization, is to identify the functions or the groups where such human factor risks are more, which includes misconducts, mistake, heavy regulatory business consequences, and internal fraud. The next step is to design the monitoring mechanism for those functions, do a role modeling from them, do a tone setting for such functions, conduct trainings for them, make them aware of what are the consequence management, modify their incentive structure, and create a contingency plan for the critical employees for these functions to make sure that the human factor risk is mitigated to a large extent. The other way to mitigate the human factor risk is obviously to automate the processes. And in order to do that, I think one can follow a very simple approach in terms of what is a maturity, what are the business critical function, where the volumes are more, do those analysis and try and automate those processes so that the overall operational risk gets reduced. I mean, if in a normal process, if a particular person would have to mention any of those 4 points, which is they no longer have to say that I need to figure this out. It is already done in the system, taken care. They no longer have to say that my organization to respond. It has already been responded. They no longer have to waste time on coordination. There is no need to communicate between two individuals. It just happens through a workflow. The moment one person approves, there's a maker checker happening within the system. It goes into the next queue, next person's bucket, and it goes through. There's no need to wait for approval. It just happens through the entire automated process, right? So just to summarize the overall thing, what I mentioned, we spoke about the definition, the evolution of the entire operational risk from the Basel standpoint from 1988, where there was only the credit risk featuring. Then 94, the market risk came, and in 2004, where Basel also realized the significance and the importance of the operational risk, the traditional way of operational risk in terms of doing a risk control self-assessment, having an operational risk policy, incident data reporting, etc. despite having those things in last 2-3 years because of the disruptions. And why disruptions was required is something we also looked at: the altered business model, the why for it, the how for it, the what for it, what kind of opportunities those altered business model brings to the table. And because of those altered business model, the traditional operational risk management is not sufficient, right? You need to apply the advanced technologies, advanced analytics. You need to revisit your framework. Keep in mind how these disruptive technologies can impact each and every aspect of your operational risk management. So that's all we spoke about. I'll just take up few questions now.
Rahul sir, we have one question from Anand Paliwalji. You can take it.
Yes. Instances where loss occurred due to fault or gaps in controls, external entity or vendor with a piece-based arrangement done. How these instances can be mitigated? I just could not understand the word appease. Maybe Saurabh, if you could also help me interpret the question.
Anand sir, you can highlight your points.
So there was one point mentioned in the chat box, APIs.
Yes.
Sorry. Thanks, Anand. Thanks for quickly adding that. So yes, as in fact, even Abhay mentioned earlier, in terms of having those SFTP based secured platforms to share the data with each other is very important to make sure that there is no data leakage there. I mean, you will have to share the data. You cannot have a printing business, right? You need to check printing, you need to credit card print, you need to print your debit cards, prepaid cards, but you cannot own a printing machine as a bank. That's not the business you want to be in. So you will obviously outsource that. And if you are going to outsource, you will have to share information about your customers with them. So there's no choice to it. Let's first agree and understand and acknowledge that, right? Now, in order to do this more safely, swiftly, we need to make sure that we are having those SFTPs in place. And in fact, frankly speaking, from a printing standpoint, there are very few vendors in India who does this. And hence, what becomes important is by default, this kind of provisions are already in place. So just to add to that point, I think Anand and Abhishek mentioned. I'll just take a few more questions which are there in the Q&A box. What are the mitigation for losses occurred by the company on account of gaps in other entity or vendor? Yeah, I think we just spoke about it.
There is only one question, I think.
Correct. I think Mr. Ajay Bhayani is also typing. Maybe Ajay, you want to speak, come online and speak as well.
Okay, so thanks a lot. Just to address what Anand's question is and to add on what Rahul you said. See, when we talk about the APIs and there is a gaps in the APIs or it's a vulnerable API, okay, it's more of a software terminology. And what happens is if there is so whenever you are onboarding a vendor or you are using the APIs of that vendor who is, who you have to work with, right? And if there is a gap, right? First thing is before onboarding, only the complete security checklist has to be matched, or else you need to really make sure that they are security compliant. There are no vulnerabilities in those APIs. And whenever the new updates are happening, the security has to be checked for all the checklists, and then only you should onboard that API. Even if during your regular processes, the APIs are upgraded before utilizing the new APIs or onboarding those new APIs, those has to be checked for the security flaws and then only make it up. There are specifically no mitigation strategies because if you are onboarding them, okay, after the thorough security check, security is something, is like, it's not easy to, I would say security is something which is always going to be a challenge because there is always going to be a vulnerability. If hacker really wants to get into those APIs and process that or hack that, there are multiple other controls also which you can apply. There is an API security solutions which are there where you can continuously keep on checking for any kind of vulnerabilities on the APIs. So there are mitigation strategies. Ultimately, once you reduce the online vulnerable risk, okay, to the most justified level, the best option is to go for cyber insurance. On that is the last option which we should. So it's like giving out the liability to some third party so that your risk can be mitigated.
Ajay, what he's also mentioning that, and in fact, I'm trying to understand his question again. There are some changes which are done by entity or the vendor. I mean, the bank is making some changes in his or her processes or in his or her application, or the vendor is making some changes in his or her application without informing to each other, and because of which there is a loss of a data, or maybe a transaction could not get processed.
Now, this is something which we are talking about, the absence of process control, right? The absence of change management, right? So if there is, now again, it is also important to understand who owns the API, whose APIs it is. So for example, if I'm providing a platform to, or bank is providing a platform to me, right? So whose API is being used and who is responsible for those APIs, right? So that's the complete onus lies on that particular company. And of course, the change management process has to be followed at that time.
Agreed.
I think we have covered the question in well. Any other questions is available? I think there is no more questions. So before going to the vote of thanks part, I like to mention here, we at WRC is highly committed to empower our members. And recently we had National Conference on Internal Audit. Today we are completing internal audit of financial service entities. And on to celebrate MSME Day, on 27th, we have scheduled a very good programs in which we cover the funding schemes of SIDBI and the IPO listing for SME. So please join us over there. This is physical program at BKC. And in these sessions, I think Rahul sir have guided us on all the operational risk management, how we can do in financial services, how to tackle and be future ready with the current scenario, key management areas, everything he have covered. So the presentation was completely in detailed and great in terms of knowledge sharing. So on behalf of WRC and all the attendees, I'm here to propose a well-deserved vote of thanks to you for sparing your valuable time and guiding us on the topic. Thank you very much, Rahul sir, for joining us here, and each and everyone also I like to thank for joining us over here. Thank
you so much, Saurabh. Thanks for the opportunity. It was good interacting
with
everyone.
Yeah, we are looking for more opportunity for with you. Thank you.